Okay, good day, everyone. Today is Saturday, the 3rd of July, 2021. Today's section will be much on how do we account for impairment of an asset in line with the requirement of IAS 36. Now, IAS 36 provided us with the guidance to some assets with respect to how such assets that fall within the scope will be subjected to impairment assessment. And all what we need to know borders on one, how do we identify if an asset has been impaired? What are the triggers? Okay. 2, how do we subject an asset to impairment? And 3, impairment loss that may have been recognized from this assessment, how should such impairment be recorded in the financial statements? 4, we'll also look at a situation where the dry bone could rise again, where conditions subsequent to impairment of an asset has improved the condition of that impaired asset such that there may be need to reverse earlier recognized impairment losses. What are the conditions that need to be fulfilled before such an earlier impairment loss is reversed? And could it more or less affect all kinds of assets? Okay, and finally, we'll wrap it up with disclosures with respect to the standard. As you are all aware, that financial reporting borders on what we call RMD, recognition, measurement, and the disclosure, which goes in line with the presentation. Okay, now let's start with the objective of this standard. Now, what is the objective of this standard? Now, IAS 36 tends to prescribe the procedure that an entity needs to apply to ensure that all of its assets are carried at not more than their recoverable amount, which means the carrying amount of an asset should be some that can be recovered either from use of such an asset or from the outright sale or disposal of such assets. Therefore, the objective of the standard is to ensure, as far as practicable, that at no point is a carrying amount of an asset which is recognized in our financial statement exceeds the recoverable amount. And it's made known that an asset is carried at more than its recoverable amount if the carrying amount exceeds such an amount that will be recovered to use or sale of such an asset. And the standard will make us understand from its objective that if this situation arises, the asset will be described to have been impaired or to have suffered an impairment loss. And therefore, the standard requires us ultimately to recognize an impairment loss. An impairment loss is a loss. And from the conceptual framework, an impairment loss is an expense, okay? But we'll see a situation as it moves on, how this expense is recognized in profit or loss, an exception to that rule where such may not be recognized in profit or loss. Rather, it may be recognized in other comprehensive income. Okay, now, also the standard from its objective specifies when an entity should reverse an impairment loss, and also the standard prescribes the appropriate disclosure measurement for us. All of these are what we are going to discuss in the course of our discussion. Now, let me switch to my notes. We'll start our discussion using our notebook to make further explanation or illustrative analysis. The topic of discussion is impairment. of assets in line with IAS 36. Okay. Now, as I've said earlier, I've more or less tried to summarize what the objective is. And to move further, I want us to first of all understand the scope of the standard. And the scope will guide us in knowing the limitation to which you can apply this standard. As I've said earlier, you must ensure that at no point you delve into application of a standard without first of all identifying whether the transaction to which you want to apply it falls within the scope of such a standard. Okay, now in doing so, let's look at what does this standard covers. Now, the standard we apply to all assets. I repeat, the standard we apply to all assets other than those that has been specifically addressed in other standards. And what are those assets that by way of another standard, they have been addressed with respect to how they are subjected to impairment loss or a write-down in value. Remember, impairment loss is synonymous to writing off a part of an asset, thereby reducing the carrying amount of an asset to what is recoverable, which is also in some other standard, the word write-off and write-down is used in that context. One of those standards is inventory. Now remember, inventory will tell you that you recognize your value of inventory at the lower of cost and the net realizable value, which means net realizable value in that regard is a recoverable amount, such that anytime cost is above such an amount, you write it down. And the difference is taken as stock write-off in your books, which is also a component of cost of sales. Therefore, since IAS 2 has taken cognizance of that, that will no longer be, will fall under IAS 36. That is the reason why. Not that inventory is not an asset. Another one is that, remember, we have discussion, extensive discussion on IFRS 15, where we emphasize on contract assets, okay? And we also emphasize on cost of obtaining or fulfilling a contract. Now, the requirement of IFRS 15 has addressed how a contract asset may be written down to what is recoverable, subject to the fact that such recovery may not be probable or possible in the immediate future. Now, that's why that is also excluded from this scope. Likewise, we've dealt with IAS 12, where we talked about deferred tax assets. And remember, we discussed something about asset ceiling test, if you remember, asset ceiling test, okay, which I will call ACT. And we discussed that under IAS 12, where the deferred tax asset is recognized subject to what is recoverable from future taxable profits. And the portion that is not recoverable will be derecognized or not recognized. And the act of derecognizing it is also a principle in tandem with writing down the kind amount of an asset to what is recoverable. And that is the reason why you find out that IAS 36 does not apply to deferred tax assets. If you also go back to IAS 19, where we discuss employee benefits, we also make reference to asset ceiling test, okay? In that, asset ceiling test was also recognized there, where, remember, we said you net off your planned assets, which is the fair value of your planned asset with the present value of your defined benefit obligation. You only have a net of planned assets if you are overfunded, and you are overfunded when the fair value of your planned asset is more than the present value of your defined benefit obligation. At that point, instead of you having net of a liability, you're having net of an asset. And in that regard, you can only recognize that asset upon certain condition, which is asset ceiling. And that condition is that such amounts must be capable of being recovered from future contribution, which means it can lead to reduction of future contribution and some other things based on the trust deed in the scheme of arrangement. And because of that, that does not fall under IAS 36 also. Likewise, investment property. Not all of investment property will not fall, but rather investment property that is measured at fair value will not be subjected to impairment test. If you remember, when we discussed IAS 40, we discussed that such is not subjected to depreciation, neither is it subjected to impairment. Those are investment property carried at fair value. Reason because the fair value will have impliedly more or less capture any possible impairment loss such that it will have been reflected by way of the fair value loss, if any. Okay, and that's why it is scoped out of IAS 36. Likewise, financial assets. All financial assets that are within the scope of IFRS 9 are equally going to be exempted, except for financial assets that is carried at cost. No financial assets should be carried at cost, but there is more or less exception to that effect. Very rare. Okay, it's one of those exceptions to the general principle, and that relates to equity that is carried at cost. Though equity should never be carried at cost, but a situation where there's no reliable basis to measure such equity at fair value, due to the fact that one, it does not even have a market, two, there are no observable information, whether market or otherwise, that can reasonably be used to fair value. Such impliedly, reluctantly, will be carried at cost, and such compulsorily must be subjected to impairment in line with IAS 36. Okay, and that also speaks to investment in associates. Remember, when you use equity accounting for investment in assets or joint venture, the equity accounting deem it fit that you carry it at cost, subject to your share of profit or loss in the asset or joint venture from this point of investment up to the current period. Such investment equally, because it's not within the scope of IFRS 9, but rather within the scope of IAS 28, is subjected to impairment under IAS 36. Likewise, though we've not discussed on biological assets, we'll discuss on biological assets along with intangible assets when we get to IAS 41, agriculture, and when we get to IAS 38, when we discuss intangible assets. Now, but for biological assets, they are scoped out of this standard because IAS 41 provided guidance to which biological assets are subjected to impairment, if any. Likewise, for insurance contract under IFRS 17, okay, by nature, they are equally taken out because IFRS 17 provided guidance to which such assessment can be made. And finally, for assets that are classified, that is not current assets in this case, that are classified as held for sale in line with the requirement of IFRS 15. And IFRS 15 deals with non-current asset held for sale and discontinued operation because the standard, which is IFRS 5, provide guidance for such, it is equally scoped out of this. And this is the reason why all of these items, though they constitute assets, but they were scoped out of IAS 36 for the sole purpose of subjecting those assets to impairment. Any question at this point before I proceed? Any question at this point?
Okay. The impairment, you said impairment is like a write-off. But it's more of a, it's more like a provision because when you impair, you don't write off, you still warehouse the write-off. I don't know what you know what I'm talking about. I'm sure you know what I'm talking about. You know, if you write off, the thing it leaves the books 100%. But impairment doesn't leave the book. It's like you make a provision for it. So I think there are two different things.
Okay, let's start by saying, what is a provision? You don't provide for impairment. It's a wrong narrative. That's why over time, the standard tried to re-emphasize it by saying allowance for impairment or allowance for credit losses, not provision. Even though the narrative is still being used in practice, but that is not necessarily appropriate. Provision should be restricted solely for liability. Provision should not necessarily be used in the context of an asset so that you don't misconstrue it the same way you've thought of it. That's a gross misconception. Okay, but I will explain. Dry bone can rise again. Do you agree?
Yes.
Bad debt can be written off. And what has been written off as bad debt can be recovered in future period. Do you agree?
Yes.
Stock losses is a write-off. There can be stock gain in the future, which is more or less like a substitution of earlier written off stock loss. Do you agree?
Yes.
Therefore, what then that means that write-off may not be permanent when it seems to be permanent. Do you agree?
I agree, but if you vis-a-vis fair value goes up and down, but we just take the fair value. We don't use it as allowance. When fair value, fair value is a one-off thing. You just take your fair value, and if it goes up tomorrow, you take cognizance of that. Goes down, you take cognizance of that, and that just goes like that.
No. You are trying to mix up things now. You are bringing in fair value. We'll discuss fair value, but we might still discuss it again. Let's discuss your concern. You said provision is temporary. You don't take it off the books. That's why it's different from write-off. And I'm saying that that is not correct for two reasons. One, provision is a wrong description of what we are talking about. What we are talking about is allowance for impairment. You understand? Not provision for impairment. You don't provide for impairment. You recognize or you create an allowance for impairment. Are you getting it now? Two, whether you call it provision, whether you call it an allowance, do you understand? Is a form of write-off. And you are trying to compare that write-off is something that is permanent. You take it off the books totally.
Yes.
But allowance or what you call provision is still in the books. And I'm saying that that is not necessarily going to be a doctrine or a standard, because what you have written off your books can still be brought back into books. And you all agree to that. Therefore, what you need to first of all know is that what is the concept of impairment loss? Impairment loss means that you have recognized a portion of the carrying amount of an asset that its recoverability is highly non-probable. That is, it's more sure than otherwise that you can get value of this again. The same thing happens to write-off. Anything you write off, you are writing it off because the recoverability of that value is highly, not only subjective, but highly conditional upon things that are grossly uncertain and remote. Do you get what I'm saying now? Therefore, let us take notes. We are still going to, we have not even started discussion on impairment. We have not even identified what impairment is. We have only, from objective, described it. Okay, to do that, probably by the time we define terms and we go into recognizing what impairment stands for, probably we'll be able to make better meaning of it. Does that make sense?
Yes, sir.
Okay, on that premise.
I just want to ask one question.
Okay. Yes.
For instance, I'm looking at a football club that has a number of football players that form, a core part of their business activities. So in a situation whereby you bought a football player a certain amount, very expensive, And, you know, and over time, the performance started declining. Okay, the person is not able to deliver as much as was expected or as much as he did initially. So can we say that diminution in performance is an impairment of that person's value?
Okay, the first thing I'll put to you is, how do you believe football clubs recognize the sign-off fee for a player? When they say they buy Ronaldo for $150 million, what do they recognize it as? I can't hear you. You are muted.
There's a bit of noise here. That was why I couldn't unmute immediately. Oh, I don't know exactly, but I know it must be an asset, regardless. Though human beings should not be recognized as an asset, but in this case, I think there should be an exception for them.
Exception for them. Why not exception for you? Okay, now probably I'll share some resource material to you, and probably when we get to intangible assets, we'll look at that also. Okay, the value to which they sign them off are capitalized, not the value of human being. They are not paying for the human being. They are paying for right to use that human being, which means it's a form of intangible rights or assets, which is capitalized. And as you have said earlier, this standard also applies to that, because the standard applies to both tangible and intangible, applies to all assets except those that are specifically excluded based on those things I've explained, or because another standard separate has addressed their own impairment. Which means once you have a player and probably he has injury and he cannot play for 1 year, which means part of the value is supposed to derive from playing football, you do jersey on that player and all sorts of things, you'll not be able to get it, which then means that such may have suffered an impairment loss. Once we get to triggers or conditions or factors that we need to look at in our assessment to determine whether an asset has been impaired or not, we will see some of these attributes, both external factors and the internal factors. Okay, let's now look at these salient definitions. We'll pick them one by one, and I want a volunteer. Nudin has been out for some time. I think I want Nudin to volunteer to define these terms for us.
Okay, definitions. The following terms are used in this standard with the meaning specified. Number 1, carrying amount is the amount at which an asset is recognized after deducting any accumulated depreciation, amortization, and accumulated impairment losses thereon. 2, a cash generating unit is the smallest identifiable group of assets that generates cash flows that are largely independent of the cash flows from other assets or group of assets. Number 3, corporate assets are assets other than goodwill that contribute to the future cash flows of both the cash generating units under review and other cash generating units. 4, cost of disposal are incremental costs directly attributable to the disposal of an asset or cash generating unit, excluding finance costs and income tax expense. Number 5, depreciable amount. Depreciable amount is the cost of an asset or other amount substituted for costs in the financial statements, less its residual value. 6, depreciation or amortization. Depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. 7, fair value Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. IFRS 13 fair value measurements. Number 8, an impairment loss. An impairment loss is the amount by which the carrying amount of an asset or a cash generating unit exceeds its recoverable amount. Number 9, the recoverable amount. Recoverable amount of an asset or a cash generating unit is the higher of its fair value, less cost of disposal and its value in use. Number 10, useful life is either A, the period of time over which an asset is expected to be used by the entity, or B, the number of production or similar units expected to be obtained from the asset by the entity. Number 11, value in use. Value in use is the present value of the future cash flows expected to be derived from an asset or cash generating units.
Okay, thank you very much. Now, let's look at these terminologies. We are familiar with them, but there are some that I'm going to emphasize. Okay, I'll emphasize them. We won't discuss them here. We'll discuss them when we get to the appropriate section in the course of this session. Cash generating unit, which for short, we always call CGUs. Okay, we also look at corporate assets. And the essence of that is with respect to how certain assets are subjected to impairment, which is an exception to the general rule. Okay, we are familiar with most of others since we've done PPE, fair value, financial instrument, and etc. But other ones that we also look at are these two, 8 and 9. What is an impairment loss? So that we don't have a misconception about making a provision and a recoverable amount of an asset. Okay, we all know what useful life is. Another thing that is key is the value in use. And I'll show you a relationship between value in use, recoverable amount, fair value, even though I didn't emphasize fair value because we've done it severally. These three have something in common because our recoverable amount is a function of fair value on one hand and value in use on the other hand. How do we select our fair value? How do we determine our recoverable amount? These are the things we also take into consideration. Okay, that is that. Now, any other question before we proceed? Any other question? Now, let's look at the key consideration in the course of this. Now, we are going to take a consideration of what are the main questions that are begging for answers with respect to accounting issues that will come across in this whole discussion. Now, there are three main questions which you can draw from my introduction, which speaks to what will guide us in the course of this section. And the questions are as follows. One, how is it possible to identify when an impairment loss may have occurred? Simply put, how do you know when an asset has suffered an impairment? Or they can reframe it to say, what are the factors that have to be identified or associated to an asset that has suffered an impairment? That's the first question. The second question then is, since impairment tends to identify the fact that what is recoverable in amount from that asset is lower than the carrying amount, therefore, how do we determine the recoverable amount? And lastly, when we've made comparison of the carrying amounts and the recoverable amounts, and we found out that the recoverable amount is lower than the carrying amount, the question then is, how do we determine the impairment loss, and how do we recognize such an impairment loss? Okay, these are the salient questions that will give more or less room for all of the discussions we are going to have today. And as we take it one by one, the first question is, what are the factors or sources of information that make us know that an asset has suffered an impairment loss? Now, there are two factors primarily that we have to consider. And these are a group of factors. The first one is the external source of information. And we also have the internal source of information. Okay? We are going to look at all of this in trying to make justification for what we have discussed so far. Now, the external source of information are information that is wholly outside that of the entity that will make us to have a better appreciation of if there is a need to assess the amount of impairment loss of an asset. Okay, now let's look at it. Factors that triggers impairment of an asset. Now take note, these factors, not necessarily that all must be present, but one or two or more of them, once they are triggered, those may serve as indication that an asset may have been impaired. Now, having this source of information on an asset may prove otherwise, that such asset had no impairment loss after the test has been conducted. But this is the first step. The first step is to review or carry out an analysis or an assessment which are qualitative in nature to know if there is a need to test an asset for impairment. Now, the first factor is the external source of information. The second factor is the internal source of information. And we're going to look at this one by one. Okay, can somebody read the external factors for us? And we explain it one by one.
Okay. External sources of information. Factors that trigger impairment of an asset. External sources of information. There are observable indications that the asset's value has declined during the period significantly more than would be expected as a result of the passage of time or normal use.
Now, let's take note here. This means reduction in the market value. And that is outside your own control as an entity. That's number one. Number two.
Number two is significant changes with an adverse effect on the entity have taken place during the period or will take place in the near future in the technological, market, economic, or legal environment in which the entity operates, or in the market to which an asset is dedicated.
Technological changes or changes in tastes and some other things within the general market, or some other external limitation or factors. Okay, continue.
Okay, number C, market interest rates or other market rates of return on investments have increased during the period, and those increases are likely to affect the discount rate used in calculating an asset value in use and decrease the asset recoverable amount materially.
It is market indices or market factors such as interest rates, exchange rates, interest rates, exchange rates, inflation rate, and some other things that may have affected such an asset, bringing it to a reduced amount. Okay. Finally,
the carried amount of the asset of the net asset of the entity is more than its market capitalization.
That is market capitalization. When there has been a source of permanent reduction in the value, in the market value of a company, such that it has, for some period of time, consistently fall below its net asset value. In that case, it will be seen as something that is interim or temporary, but it's something that is of permanent nature. And probably we'll speak to that when we get to subjecting equity investment to impairment, which is against the common rule. But where we subject it to impairment and there's an impairment loss, under what condition must we recognize the impairment loss? And what is the consequence of doing so? We'll discuss that later. Okay, now I want somebody else to pick on internal sources of information.
How we do that? Internal sources of information. E, evidence is available of obsolescence or physical damage of an asset. F, significant changes with an adverse effect on the entity have taken place during the period or are expected to take place in the near future. In the extent to which or manner in which an asset is used or is expected to be used. These changes include the asset becoming idle, plans to discontinue or restructure the operation to which an asset belongs, plan to dispose of an asset before the previously expected date, and reassessing the usefulness of an asset as finite rather than indefinite. G, evidence is available from internal reporting that indicates that the economic performance of an asset is or will be worse than expected.
Which means it brings about a reduced contribution to the business. Therefore, these are internal factors that we also consider with respect to an asset to have suffered an impairment loss. Okay, can anybody make a narration, or can you more or less make an expression of your experience with respect to this, so that we can discuss it extensively before we move on to one other factor that we need to look at when it comes to investments? Okay. Anyone?
On my experience, like, we always ask the client, as an external auditor, we always ask clients for reports on investment, their investment test reports, and that will determine the kind of adjustment that we're going to pass, but I think also an auditor should also have the skill to be able to see whether the asset is impaired or not, or to what extent it has been impaired, other than depending only on what the client had provided. So this is the angle that I'm looking at it from. But You know, based on my own experience, I must be honest with you, I've always relied on client reports. Though I do physical check, but there are things that I may not totally have understanding about to be able to make a valid judgment as to whether what the client had recognized is good enough or not.
Okay. Yeah, as an auditor, there's a degree to which you rely on the internal processes of a client. And that's why you test for controls. Okay, it's only when there's a weakness in control or you are not satisfied enough that you now go into substantive testing, whereby you want to make some observation yourself. And again, the judgment that is made by the entity will be communicated to you as an auditor. And you also have to examine that judgment on how reasonable it is to what is observable in the open space. And from there, you can be able to make a conclusion whether you need to further reassess what has been done or not. Again, remember, it's not an exact science. Okay. Any other contribution?
Okay, I think that for me, it's personal experience. Entities are very reluctant to, usually reluctant to impair their assets. I might be wrong, but from my personal experience, it usually occurs as a result of maybe the external auditor is probing, is asking questions, and such situations, and there is no evidence that this thing can generate this amount of returns, or it is such situations that I've seen that usually leads to the external auditor impairing an asset. But entities just impairing their assets is usually rare in my own little experience.
Okay, now I think entities do test. An entity that has a strong governance structure and a strong accounting policy will do that intermittently. And that's why we are saying that probably our discussion will get to frequency of test and assessment of assets for impairment. Probably that will explain why you might not have seen entity doing it more often. Okay, but let's look at it. I told you earlier, when you have investments in subsidiary that's carried at cost, when you have taken the option of IAS 27, or when you equity account for your investment in joint venture or associate in line with IAS 28, how do you subject such an investment to impairment test? There are also triggers, and the trigger is with this perspective. Now, you can see a trigger from the perspective of the dividend that is received from your equity investment in a subsidiary, joint venture, or associate. Now, for an investment in a subsidiary, joint venture, or associate, the investor recognizes a dividend from the investment, and evidence is available that the kind amount of the investment in the separate financial statement exceeds the kind amount of the consolidated statement of the investment of the investee's net assets, including associated goodwill, or the dividend exceeds the total comprehensive income of the subsidiary, joint venture, or associate in the period the dividend is declared. These are indicators that such an investment in a subsidiary, joint venture, or associate in the separate financial statement of the entity may have suffered impairment loss. Okay, and that is that. We need to take notes. Now, to summarize it there is that one, if the dividend you have received is more than the profit of those entities, it means the company is probably trying to liquidate its value by paying you dividend as a way of reducing the equity, and over time, they liquidate the company. Or signals that the company is struggling, but in order to keep the shareholders alive, that's why they are paying part of their capital out as dividend. That's number one. Number two is a situation where the kind amount, let's say your cost in your separate financial statement is even far more than your share of the net asset at the consolidated level. or more than your equity value when you have used equity accounting methodology for your investment in asset or joint venture, it then means that it may signal that such investment may have suffered a loss. Okay, and that is that. But the question is, what is the frequency of subjecting an asset to impairment? Now, assets are only to be subjected to impairment test once there is at least a trigger or an indication as earlier identified. If you have at least one of them, is a trigger, but again, materiality of it must be taken into consideration. Which means impairment of an asset is not necessarily a yearly thing. Which means you only test it for impairment. It can be once in 4 years it happened to a particular asset when you have seen this obvious reason. One of those reasons, if you remember, the external and the internal, we're giving some of them, even though they are not exhaustive. Okay? But what we are saying here is that you subject it to impairment test once there's a trigger or when there's an indicator. But there are exceptions to the rule. The exception is such that some assets will still be subjected to impairment regardless of not having a trigger or not. Now, there are some assets that you don't need to even look for trigger, but compulsorily, you must subject them to impairment test. And these are assets that by nature has indefinite useful life. By nature, they have indeterminable useful life. And this includes intangible assets. Intangible asset that is of indefinite life, or intangible asset to which its value is not yet determinable in totality must be subjected to impairment. Likewise, goodwill arising from business combination, acquired goodwill, or what we call the purchased goodwill, must equally on an annual basis be subjected to impairment test. These are the exceptions to the general rule. Similarly, land will be subjected to impairment test on an annual basis. Okay, the essence of it is that land that is not depreciated should at least be subjected to impairment test on an annual basis. And the way to subject such land to impairment test is very easy because most land has a market value or at least has a rateable value or observable value based on what land is going for in that particular area. Okay, these are the only exceptions to the general rule, which means the only time you can convince yourself that some entities are not complying is if they have goodwill or they have intangible asset of indefinite useful life and they are not doing such impairment tests on an annual basis. Only that situation will give rise to the fact that they are not in compliance with the provision of IAS 36. Does that make sense, sir?
Yes, sir.
Does that make sense, sir? Yeah.
Yes.
Yes.
Now, the next question is this. Okay, any other question? Any other question? Now, next question is this. How do we test for an impairment of an asset. How? How do we test for an impairment of an asset? Remember, assessment or impairment review is qualitative in nature. Now, testing to determine the amount of impairment loss is quantitative in nature. How do we test for an impairment in an asset? Who will answer me? Who can give us guidance? Anyone?
I believe if we want to test for impairment of an asset, we need to obtain the carrying amounts of such assets, and we need to obtain the we need to obtain the carrying amount of such assets, and we need to obtain the value in use. I mean a recoverable amounts of such assets. Then we compare the carrying amounts with the recoverable value. And when we notice that the carrying amount is greater than the recoverable amount, we say there is no existence of impairment. But if the carrying amount is less than the recoverable amount, then we say there is existence of impairment.
Now let's look at it from this perspective. Now, the act of recognizing or trying to test for impairment is to see whether we need to revise the carrying amount of an asset. And therefore, to obtain a new carrying amount of an asset, what you need to do is to compare our carrying amount as at the reporting date, or let me say as at the test date, because again, we'll discuss that test of an impairment is not compulsory to be carried out at the end of the year. It could be carried out any time during the year, but the condition is if you always carried out your impairment test on every 30th of June, next year must also be 30th of June, not January in 1 year, March in 2nd year, June in 3rd year, no. You understand? But usually in practice, impairment test is recommended, or usually, don't let me use the word recommended, because there's no one that recommended it, but usually in practice, we ensure that we do it at the reporting date so that all measurements are in alignment. Okay, probably in future standard, a revision might be done to the standard, which will mandate that at least you must carry it out at your financial year end. Okay, you compare the carrying amount with your recoverable amount. Now, carrying amount is known to us as the amount to which we have recognized an asset for in our balance sheet as at that particular point in time. But what is probably new to us is recoverable amount. And recoverable amount by definition is how much can you realize from that asset, either from use or from disposal. Use means if you continuously use this asset over its useful life, how much can you realize in today's money value? And if you sell this asset outrightly by way of disposal, how much can you realize? Okay. Therefore, the question then is, recoverable amount will surely be the higher of the value you can realize from outright disposal, or the value you can realize from continuous use. Now, the value realized from disposal is determined by the fair value. The fair value being what is realizable from market observable perspective, whether at market price or at different levels. Remember, we have 3 levels, hierarchy levels, level 1, level 2, level 3. Okay, your fair value, less cost of disposal. Now, cost of disposal, if you remember, we had a discussion of the definition. Now, your cost of disposal is your cost to sell an asset, which will not include other costs that are operational to the use of the asset, but rather you are dealing with the cost solely incremental in nature that is directly attributable to you selling off the assets. And this will exclude taxes you will pay in terms of capital gain tax or finance cost or anything incidental to it. But rather, you are only dealing with incremental cost that is solely attributable to you making that disposal. And that is what you are going to compare with your fair value, which is a price obtainable from the market perspective. Okay, and that's what you do at that point. Now, you now compare that value with value in use. Now, if you go back to our conceptual framework, okay, in the conceptual framework, we identify that there are 2 bases of measurement for the element of financial statements, especially assets and liabilities. Historical cost, which is the cost, and the current value. I remember the current value was said to include the fair value, the present value, and the current costs. Now, the present value has 2 perspectives. Present value being the discounting of the future cash flow associated with an asset or liabilities. Now, when you discount the expected cash flow from an asset over the future period and you discount it back to the present value obtainable in that regard is what we know as value in use, which is the present value of the discounted cash flows obtainable from the use of an asset. Okay, whereas the present value for liability in that regard is what we call fulfillment value. But again, we are not dealing with liability here. We are extensively discussing on an asset. Therefore, if you go back to the definition again, you'll find out that what is value in use is simply the present value of the future cash flows expected to be derived from the asset through its usage. Any question at this point? Any question? Which question?
Yeah, I don't have question at this point.
Okay, who else?
Sorry, I will want to know the intangible assets. Intangible assets that has no definite useful life. How are we going to carry them at costs?
Remember, when we discussed property, plant, and equipment, we identified some assets with indefinite useful life, or indeterminate useful life. And what did we say? That such assets will not be depreciated, but rather, at least on an annual basis, will be subjected to impairment test. Similarly, that is what happens to such an intangible asset. Does that make sense to you, sir?
Yes, I want to know, are we carrying them at their initial cost? Or because since there is no depreciable, since there is no useful life, it will not be depreciated.
Yes, so carry it at cost, subject to payment.
Okay, that's fine.
Okay, now let's look at this. I want somebody to go through this. What is a What is an asset recoverable amount? You know, we've discussed it, but let's look at this in practical terms. Over to you guys.
Okay. What is an asset recoverable amount? The recoverable amount of an asset should be measured as the higher value of A, the asset fair value less cost of disposal, B, its value in use. An asset fair value less cost of disposal is the price that will be received to sell the asset in an ordinary transaction between market participants at the measurement date, less direct disposal costs such as legal expenses. If there is an active market, if there's an active market in the assets, the fair value should be based on the market price or on the price of recent transactions in similar assets. B, if there is no active market in the asset, it might be possible to estimate fair value using best estimates of what market participants might pay in an orderly transaction. Fair value less cost of disposal cannot be reduced. However, by including within cost of disposal any restructuring or reorganization expenses or any costs that have already been recognized in the financial statements as liabilities. The concept of value in use is very important.
Okay, thank you very much. Now let's look at it from this perspective. Value in use is very key. Why? We've discussed extensively the aspect of fair value, especially when we are discussing financial instruments. But value in use is a new concept that probably we are coming across for the first time. Okay, and therefore we'll look at it from this perspective. Value in use. Let us look at it in detail. Can you continue your discussion here?
Okay. Value in use. The following elements shall be reflected in the calculation of an asset's value in use. A, an estimate of the future cash flows the entity expects to derive from the asset. B, expectations about possible variations in the amount or timing of those future cash flows. C, the time value of money represented by the current market risk-free rate of interest. D, the price for bearing the uncertainty inherent in the asset. And E, other factors such as illiquidity that market participants would reflect in pricing the future cash flows the entity expects to derive from the asset. Basis for estimates of value of future cash flows. In measuring value in use, an entity shall A, base cash flow projections on reasonable and supportable assumptions that represent management's best estimate of the range of economic conditions that will exist over the remaining useful life of the asset. Greater weight shall be given to external evidence. B, base cash flow projections on the most recent financial budgets or forecast approved by management, but shall exclude any estimated future cash inflows or outflows expected to arise from future restructurings or from improving or enhancing the asset's performance. Projections based on these budgets or cash or forecast shall cover a maximum period of 5 years unless a longer period can be justified. C, estimate cash flow projections beyond the period covered by the most recent budgets or forecast by extrapolating the projections based on the budgets or forecast using a steady or declining growth rate for subsequent years, unless an increasing rate can be justified. This growth rate shall not exceed the long-term average growth rate for the products, industries, or countries in which the entity operates, or for the market in which the asset is used, unless a higher rate can be justified. Composition of estimates of future cash flows. Estimates of future cash flows shall include A, projections of cash inflows from the continuing use of the asset. B, projections of cash outflows from projections of cash outflows that are necessarily incurred to generate the cash inflows from continuing use of the asset, including cash outflows to prepare the asset for use, and can directly attributed or allocated on a reasonable and consistent basis to the assets. And C, net cash flows, if any, to be received or paid for the disposal of the asset at the end of its useful life.
Continue. Foreign currency future cash flows. What effect does that have?
Foreign currency future cash flows. Future cash flows are estimated in the currency in which they will be generated and then discounted using a discount rate appropriate for that currency. An entity translates the present value using the spot exchange rates at the date of the value in use calculation. Discount rate. The discount rate or rates shall be a pre-tax rate or rates that reflects current market assessment of A, the time value of money, and B, the risk specific to the asset for which the future cash flow estimates have been adjusted.
Okay, thank you very much. Now, when we look at everything that we've discussed, you'll find out that what is critical in our source of discussion is with respect to the value in use. Now, what are the critical things you need to consider? One, value in use deals with future cash flows, and you have to estimate it, and the cash flow is more or less attributed to the asset in terms of what it can generate. Two, is that in building that, we must more or less do a form of possible variation in the amount and timing, which means you must build a form of expectation. And such expectation is known from the concept of expected value. Okay, which means it's a scenario-based analysis. Next one is issue of time value of money, because future is involved. And what you have to make use of as your discount factor or discount rate is the current market risk-free interest rates, and which is synonymous to, probably we say, government bonds with maturity similar to the remaining useful life of the assets. Okay, lastly, okay, before the last one, the price for being, the price for bearing the uncertainty inherent in the asset must be considered. Okay, which means you also consider a form of adjustment, if any. And finally, you must consider other factors with respect to illiquidity. And this is common to an asset that does not have a ready-made market, or of which its market is not necessarily active. All of this will be built into the process of determining value in use. Now, let me give you a simple analysis of that. Let me just try and create a simple scenario for value in use. Now, let us try and do this. Estimating value in use. Now we might have information such that an asset has this information associated with obtaining its value in use. The carrying amount of the assets The expected future cash flows derivable from its usage over its remaining useful life is as thus. Year 1, year 2, year 3, year 4, and let me say year 5. And just build a random value. Between 100,000 and 150,000. Okay. I like this particular value. Okay. All these values should be in Naira. Okay. Now, corporate bond yield, government bond yield, of 5-year maturity, okay. Let me say kind amount is 301, for example. Now, what I want to determine here, required. 1, what is the value in use? That's the first question we want to address. Now, what is the value in use here? Question 1. I look at my year. I look at my cash flows. My discount factor. What will be my rate? My discount rate. Is it 12% or 8%?
8.2.
Why?
Because it is the risk-free rate.
Okay, because it's a risk-free rate. Thank you. 8.2. And my present value. Okay, my year 1, 2, 3, 4, 5. And what are my cash flows? These are my cash flows. My discount factor, remember 1 plus R. What is my R now? 8.5, 8.2%. I'll fix it because it's a constant variable. Raised to power minus the year you are discounting backward. Year 1 backward. Year 2 backward. I can restrict it to 4 decimal, but it doesn't matter. And what is the product? I multiply my cash flow with my discount factor, and I'm able to obtain this amount. At the end of the day, I sum this up, and I have my recoverable amount. Okay, but take note, this recoverable amount, if you go back to our discussion, is a factor of, let me put this as red so that you know that this is what I picked, and there's a reason why. The recoverable amount is 512,275 naira, okay? And it's a function of the cash flow, but this cash flow is based on the principle of expected value. And there are many things that have gone into that, and discount factor taking care of the time value of money over the remaining life of the assets to which it generates cash flows. Now, let me just take this as an example. I can copy and paste where we're having our discussion. Therefore, remember, what are the factors we considered? We estimated the cash flow and the principal year. All of the principal you have here is based on scenario analysis. Will be based on what? Scenario what? Analysis. Where you consider the various state of nature and otherwise. Okay, and here is where we obtain our time value of money. And here is where we make some level of adjustments that might affect our risk-free rates, which means our risk-free rates might be adjusted for. Okay. And this is to reflect what the reality is at every point in time. Any questions so far? Any questions so far? Any questions?
No.
Okay. Now, how do we measure an impairment loss? Okay, before then, let me give you this. Information. Can somebody read this for us?
Okay. Let's review property by decline in demand for output. Example, an entity has a machine that was purchased in January 20X1 for CU 1 million.
We can't hear you. Okay, Nuruddin, can you proceed?
An entity has a machine that was purchased in January 20X1 for CU 1 million. For 1 million CU, it is being depreciated over its estimated useful life of 10 years on a straight line basis. The carrying amount at 31st December 20X3 is therefore 700,000 CU. At 31st December 20X3, the directors become aware that a new technological development means that demand for the output produced by the machine is likely to decline significantly. Consequently, under IAS 36, paragraph 9, they are required to estimate the asset recoverable amounts.
Okay. Now, we have been able to determine value in use. Okay. Let's now determine what recoverable amount is in this regard. Let's go back to the question that we just attempted. Now, let's say the second question is, what is the recoverable amount? Given the following information. A, the fair value of the assets. B, the cost of disposal of the assets. C, capital impacts and stamp capital gain tax on the assets. Disposal. And what are the amounts? Okay. Now, this is a new question. Question 2. What is the recoverable amount given the following information? The fair value of the assets, 520. the estimated cost of disposal and the estimated capital gain tax on the asset disposal. Therefore, how do we solve this? Now, the recoverable amount is the area of the figure 1. The fair value less cost of disposal and the value in use. Now, let's pick them one by one. The value in use has been determined before, which is 512. Let's now work out working notes. What is fair value less cost of disposal? Now, from our analysis, that will be the fair value let me just copy it. That will be the fair value less cost of disposal, which will not include financing costs or taxes, but rather incidental costs, which are incremental in nature to ensure that you're able to sell the assets. Our fair value of the asset is 520. Our estimated cost of disposal is this. Therefore, what is our value? What's our fair value less cost of? It is this. Therefore, if that is the case, the standard says our recoverable amount is the higher of these two. Now, what is our recoverable amount now? Our recoverable amount, I'll put the answer somewhere there. Is the higher. Higher means the maximum of 503 and 512. What is it? 512. Does that answer our question? Therefore, I can copy this and also paste it. Any question on this? Okay. Any question so far?
Hello, Mr. Miwa.
Yes, sir.
Did you hear what I said?
I didn't hear what you said, sir.
Pardon?
I didn't hear what you said.
I said the asset is the carried amount of the asset is 302, and we have calculated recovering amount that is higher than the carried amount. So there is no impairment in this.
No, we have not even talked about impairment. We are addressing each one by one. We are saying that is even value in use. And I'm trying to show you how you obtain value in use in practical terms. The second one, I'm not saying that, okay, what is the recoverable amount? I'm not trying to make use of that value in use compared to the fair value less cost of disposal to even determine recoverable amount. Probably question 3 might not say, is there impairment loss? We've not gotten there. You understand? Do you get it, sir? We need to follow it up in that logical sequence so that we can have better understanding. Now, let's come here now. Probably this way will trigger question 3, which says recognition and measurement of an impairment loss. Let us even know when impairment loss has arisen. Okay? Impairment loss, from the definition, sorry. Is the excess of carrying amounts of an asset over its recoverable amount. Take note of that. That is scenario A, scenario B, and scenario C. Let's say we have the carrying amounts as reported in balance sheet to be 100 across board. Our figure in Naira. And we'll now compare it with recoverable amount. Let me write it clearly. In this case, the recoverable amount is, let me say 100. In this case, is 90. In this case, is 110. The question then is, what is the impairment loss? In this case, the impairment loss is nothing, have you? Because they're exactly the same, but it's rare. In this case, the impairment loss is 10. And in this case, what is impairment loss? Who can answer that? Who can answer that?
In scenario C, there is no impairment loss.
Why? Why?
Because the value we carry in the book is lower than the recoverable amount of the assets.
you have more expectation that you will recover at least the amount, that is at least the carrying amount. Okay, and therefore there's no impairment. Where there's no impairment of an asset, the impairment loss is nil, is zero. And there's no impairment of an asset if at least the recoverable amount of that asset is equal to or more than the carrying amount. Now, if that is the case, let us go back to our exercise. The third question will say that is the asset impaired? And if yes, by what amount? Let's try and answer it. Question 3. Who can answer this? Is the asset impaired?
No.
Why?
Because the carrying amount of the asset is 301,000, while the recoverable amount that we estimated is 512. Invariably, it implies that we can actually recover the value of the total assets from all indications.
Now, we compare to ascertain an impairment loss. We compare the following. We compare the carrying amounts of the assets with what? With the recoverable amounts of the assets. And you do that on the same measurement date. What is the carrying amount? 301. What is the recoverable amount? This. The question then is the test. Is the assets impaired? Now I can, because I want to make it a model, I can format it and say, if this is greater than this, that is, if carrying amount is greater than recoverable amount, it should give me yes. Sorry, it should give me what? No. That is, if the carrying amount is greater than the recoverable amount, it means the asset has been impaired, which means yes. Otherwise, it has not been impaired. Therefore, you give me what? No. Which is, in this case, my answer is no. Now, if I change this one now to, let me say 600, what will it give me? It will give me yes. Okay, but I return it back to what it is. No. Therefore, I can now recommend, since the asset is not impaired, the amount of impairment loss will be nil, or simply put, 0. Does that make sense?
Yes.
Now, I cannot say, if that is the case, I'll say comparison, or let me just say test here. I cannot test them. And supposing there's yes, what will have been the impairment loss? It should give me the same thing, the carrying amount, the recoverable amount, and it will give me the minimum of 0 or the difference between the carrying amount and the recoverable amount. Now, let me say if this give me yes, therefore, if this equals what? Yes. Now, always return the difference between this and this. Otherwise, return 0. Now, you see what I've done also. What I've done is that since it is no, it will not test anything further. It will just give me 0. But if it's yes, let me take this back to 600. It will now give me the amount of impairment loss to be 87,625. Does it make sense? But because it is 301, it's telling me what? No. And therefore, the amount of impairment loss is 0. Does that make sense? Any question? Now, I'll copy this also. Any question, please? Okay, now, impairment loss is the excess of the carrying amount of an asset over its recoverable amount, as demonstrated. The question then is, how do we recognize impairment loss in the financial statements? The first rule is this. Now, impairment loss has impact on two sides or two components of the financial statements. The first component is that it has effect on the financial position. And second one is that it has effect on the financial performance, and where practicable, has effect on other comprehensive income. And we're going to get there. Now, what is the first deal? The first impact is that the carrying amount
Excuse me, we can't see what you're doing.
Okay, sorry. Okay, can you see it now? Can you see it now?
Yes.
Okay, the first impact is that the carrying amount, which you can find in the statement of financial position of the assets, will be reduced by the impairment loss. What it means is that, for example, if the previous carrying amounts before impairment was 100 naira, and the impairment loss is estimated at 10 naira, then the new carrying amount will be old carrying amount 100 less what? Impairment loss 10. I will now have what? The new carrying amount. Does that make sense? That is the first impact within the balance sheet. Now, what is the second impact? The second impact will be on the financial performance. I'll call it A. The impairment loss of 10 naira will be charged to the profits or loss as an expense. That is it. This treatment is valid for all assets that are measured at historical cost. Do you agree? That's why I said A. Why? Because as we move on, we'll be constrained to know that there are some assets that are not measured at historical cost. For assets that are not measured at historical cost, such as items of property, plant, and what? Equipment under what? IAS 16 and measured at a revalued amount. The impairment loss would be treated as follows. One, where the impaired assets had been revalued, had been previously, let me write it well, had been previously revalued, the impairment loss would first be used to reduce the revaluation surplus. That's number one. Number two, where the revaluation surplus is not sufficient to absorb the loss, the impairment loss, the remaining impairment loss or the excess will be charged to profits or loss. And that will be in tandem with what we have done earlier here for those sums carried at cost. What that presupposes is that you can't claim to have a revaluation surplus or reserve on an asset that has been impaired, which means such impairment in principle is treated as a revaluation decrease rather than as an impairment. And if it is a revaluation decrease, it means the revaluation surplus initially created have to be reduced by that revaluation decrease. It's only the excess over what has been recognized as revaluation surplus before now that will be treated as an impairment loss that will then be charged directly to the profit or loss. Now we're going to look at that one by one. But in summary, what I've explained and I've written can be found here. Can somebody read it aloud? Recognition.
Recognition and measurement of an impairment loss. The rule for assets at historical cost is rule to learn. If the recoverable amount of an asset is lower than the carrying amount should be reduced by the difference, that is the impairment loss, which should be charged as an expense in profit or loss. The rule for assets held at a revalued amount should, such as property revalued under IAS 16 is, the impairment loss is to be treated as a revaluation decrease under the relevant IFRS standard. In practice, this means to the extent that there is revaluation surplus held in respect of an asset, the impairment loss should be charged to other comprehensive income and shown in the revaluation surplus. 2, any excess should be charged to profit or loss.
Okay. Now let's try and demonstrate that understanding there. Let's create some scenarios. Now, treatment of impairment losses on assets measured at historical costs and at revalued amounts. Now, given the following information, what will be the treatment availed to the impairment loss on the assets? Now, carrying amounts, valued carrying amounts, okay, recoverable amounts, okay. A, additional information. A, the asset in concern, the asset is measured at historical costs in line with IAS 16, and B, the assets is measured at revalued amounts in line with IAS 16. And as figure 1, evaluation surplus of two. Now let me give the carrying amounts. The carrying amount in this case is 301. The recoverable amount 280, 289. Okay, the valuation surplus is 15. The valuation surplus is 9. Therefore, how do we attempt this question? Now, the first test, let's try and do a test. Now, suggested solution. Step 1. We need to carry out this test. What is the carrying amount? 301. What is the recoverable amount? 289. Therefore, it gave us what? Yes. Now, what is our impairment loss? Our impairment loss is 12,000. Therefore, the question then is step 2. Recognition of impairment loss on the assets. Now, I have 3 options now. First with A. A is for assets measured at historical cost. Now, since it's measured at historical cost, the impairment loss of 12,000 will be charged as an expense to profit or loss in the year. That is that. B. And before then, let me show the accounting entry so that I can understand it better. Accounting entry. To do that, debit profit or loss under the heading impairment charge or impairment loss, as the case may be, and credits property, plant, and equipment. With what? With the impairment loss. Now, for the asset measure at valued amount, okay, number figure 1. Since the asset has a revaluation surplus of 15,000, the impairment loss will be charged as a revaluation decrease to the valuation surplus and reduced to 3,000. What's the accounting entry? Accounting entry. Instead of debit profit or loss, you debit the revaluation surplus. You go to the OCI, other comprehensive where you bring back part of the surplus and you match it with the impairments. so that at the end of the day, it reduces it to 3,000, and therefore impairment charge. Here you see it as revaluation decrease. Okay. Now, by how much? The 12,000. Now, how do we do the third one? B2. Since the revaluation surplus has 8,000, the impairment loss will be charged as a decrease to the revaluation surplus in the sum of 8,000, while the excess of 4,000, no, sorry, is it 8,000? Revaluation surplus is how much?
9,000.
Is 9,000. Okay. Revaluation surplus 9,000. Okay. The revaluation decrease in the sum of 9,000, while the excess of 3,000 will be charged as impairment loss in profit or loss for the year. At that point, there's no balance again in revaluation surplus accounts. And what we do is as follows. We debit other comprehensive income with the decrease. The decrease of 9,000. Another debit will go to profit or loss with the difference between the 12,000 and the 9,000 revaluation surplus, that's 3,000, and the credits of 12,000 will go to these accounts. Does that make sense?
Yes, sir.
Yeah. And that is what we try to achieve there. Any question? Any question? Okay, let's go back to our notes. Okay. Any question? Can somebody read again the treatment of impairment loss?
The impairment loss shall be recognized immediately in profit or loss unless the asset is carried at a revalued amount in accordance with another standard. For example, in accordance with the revaluation model in IAS 16. Any impairment loss of a revalued asset shall be treated as a revaluation decrease in accordance with that other standard.
Okay. Now I'll give you guys a small exercise. And I want you to model it from your own perspective as you are going to display what you have modeled for me. And On that basis, we'll move on our discussion. Class exercise. Okay, you have a few minutes to do that. Okay, can you guys present your suggested solution and provide explanation for it?
Okay, thank you very much, Mr. Mueller. Based on our discussion and the suggested solution arrived at, our parameters are this. We have the carrying amounts of the machinery to be $10,500. We also have the fair value of the machinery to be $10,000, and the cost of selling the asset is $500. And we have the present value in use of the machinery to be estimated to be $9,000. However, the question put forward to us is to determine whether the machinery is impaired. And if so, we should calculate the impairment loss. Okay, this is our solution. In the first instance, we pick out all the parameters needed for this solution, which include carrying amount, fair value of the assets, cost of selling, and the value in use. The first thing we determine is to determine the recoverable amounts of the assets. And to determine the recoverable amounts, we have to compare the disposal value, the disposal amounts of the assets and the value in use. However, to determine the disposal amount of the assets, we consider the fair value at which the assets can be sold if at all the assets we want to sell the assets. And the fair value is $10,000. However, the standard says we should not consider the cost of selling. That is why we have to subtract the cost of selling the asset from the disposal amount. That's why we subtracted $500 from $10,000. That gave us $9,500. However, we also consider the value in use for the assets. The value in use from the question was $9,000. Now, when we compare our disposal amounts and the value in use, the standard says the recoverable amount attributable to the assets will be the higher of the disposal amounts and the value in use. Invariably, the recoverable amount on these assets that we are to recognize based on the provision of the standard is $9,500. That is why the recoverable amount is $9,500. We went further to determine whether there is existence of impairment loss. To determine the impairment loss, we need to compare our carrying amounts and the recoverable amounts. However, from the question, our carrying amount was $10,500, while our recoverable amount is $9,500. However, since our carrying amount is greater than the recoverable amount, it implies that there is existence of impairment loss. However, when we deduct the recoverable amount from the carrying amount, we could see that the asset is impaired by $1,000. Okay. From our model, we try to model it out to show that if there is an existence of, is the machinery impaired? we model it to ask a question that if the machine is the machinery impaired, if it is impaired, that is, if the carrying amount of the asset is greater than the recoverable amount, the model should show yes. But if it is possible that the recoverable amount is greater than the carrying amount, the model will show us no. And this can be tested if we change our recoverable amount to be, I want to see.
Just go to the formula and click minimum instead of maximum.
Okay. No, that will not give us. I want my recoverable amount to be greater than the carrying amount. Okay, let's see.
You can go to the carrying amount in the parameters and maybe type $8,000 or something.
Okay, let me do it this way. Let me change my fair value to be, let's say, 12,000. Exactly. Okay, from what we demonstrated here, if, for example, the carrying amount is lower than the recoverable amount, the model will show that there is no existence of impairment loss. And that's what the model demonstrates here. But I'll take it back to the previous position to show that the fair value is 10,000. And that model shows that the impairment is yes.
Okay, before you take it back to the previous position, take it back to 12,000.
Okay.
Now, yes, you have the question to be answered as no. Is the machinery impaired? No. But it's telling you that you still have an impairment loss of 1,000 or probably negative impairment loss. You're supposed to have modeled it so that you give you 0.
Oh, okay. 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 It shows I need to model this impairment loss.
Okay, no problem. You guys have tried. Thank you very much. Let me share my slide. Let's go back to this. Presents your solution, and you're 100% correct in what you've done, and that's a nice try. Let's now move further to discussing the role of cash generating units. How many of you have heard of CGU before, other than the one we discussed today at the point of definition? Now, not every asset you can subject to impairment test on a standalone basis. Why? Because some may not have an active market where you can obtain fair value or reasonable basis of obtaining fair value. While some, you can't have a reasonable basis of determining the value in use because as an individual asset, it does not generate cash flow independent of other assets. Therefore, what the standard now makes us understand is that if for the purpose of impairment, an asset cannot be seen to generate cash flow independent of others, therefore, such assets, along with similar assets in which you can independently attribute cash flows to, should be grouped together, no matter how small the group may be, and such group should not exceed a group that will have qualified as operating segments under IFRS 8. Such will now be termed a cash generating unit. And in that regard, such asset, along with others, will now collectively be subjected to impairment assessment as a group of assets. And that is what we're trying to discuss here. Okay, what that means that going to look at practical demonstration of such assets that we may not be able to subject to impairment on a standalone basis, rather on a collective basis under a cash generating unit. Now, can somebody take it up from here in our discussion before I break it further?
Okay, cash generating units. When it is not possible to calculate the recoverable amount of a single asset, then that of its cash generating unit should be measured instead. Use of cash generating units. IAS 36 goes into detail about the important concept of cash generating units. As a basic rule, the recoverable amount of an asset should be calculated for the assets individually. However, there will be occasions when it is not possible to estimate such value for an individual asset, particularly in the calculation of value in use. This is because cash inflows and outflows cannot be attributed to the individual asset. If it is not possible to calculate the recoverable amount for an individual asset, the recoverable amount of the cash generating unit should be measured instead. A cash generating unit is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or group of assets. IAS 36 paragraph 6.
Thank you very much. Now, let me give you a small task. Can you think of any example where you can identify or apply the concept of cash generating unit? Can you look at any examples within your reach?
We look at maybe a subsidiary, a branch. Those are the two examples one can think of.
No, you have to elaborate. What do you mean by, are you not saying a subsidiary is just cash? Can you elaborate on what? We are looking at an asset that cannot generate cash flow independent of others. And give us an example of such assets and how it can only generate cash flow along with others.
Okay. What is coming to my mind is, let's say, a company that owns different factories. Just a portion of the factory that contains different equipment can be seen to be cash generating units, because the individual equipment you may not be able to determine the cash flow that relates to individual equipment apart from others.
Yeah, thank you. You got it right. That's an example. Such equipment might not even have a market value because they are robotic that is specialized and is specifically designed for your operation. And that equipment serve along with other equipment and other processes towards producing an output that generates cash. But on its own, you cannot attribute any cash flow to such equipment. That's an example. For example, if you have a corporate head office or corporate asset, which benefit the entire operation. For example, the head office of a bank, that's where decision makings are taken. Okay, and the question then is this: can you be able to identify that this is what the head office generates independent of others? The answer is no. Therefore, which means when you are testing such a corporate asset for impairment, you can only test it for impairment along with other assets. But let's look at practical demonstration as given by the standard in its illustrative examples. Okay, can somebody read this out for us? Okay,
question. Can you think of some examples of how a cash generating unit will be identified? The answer, here are two possibilities. A mining company owns a private railway that it uses to transport output from one of its mines. The railway now has no market. The railway now has no market value other than as scrap, and it is impossible to identify any separate cash inflows with the use of the railway itself. Consequently, if the mining company suspects an impairment in the value of the railway, it should treat the mine as a whole as a cash generating unit and measure the recoverable amount of the mine as a whole. Second, a bus company has an arrangement with a town's authority to run a bus service on 4 routes in the town. Separately identifiable assets are allocated to each of the bus routes, and cash inflows and outflows can be attributed to each individual route. 3 routes are running at a profit and 1 is running at a loss. The bus company suspects that there is an impairment of assets on the loss-making route. However, the company will be unable to close the loss-making route because it is under an obligation to operate all 4 routes. As part of its contracts with the local authority, as part of its contract with the local authority. Consequently, the company should treat all 4 bus routes together as a cash generating unit and calculate recoverable amounts for the unit as a whole.
Okay, thank you very much. Now, let me now give you a practice question to demonstrate your understanding. Okay, can you read out the question? And I want somebody to provide guidance to it before I provide such guidance.
Okay, the question is, Minimart Co. belongs to a retail store chain, Maximart Co. Minimart Co. makes all its retail purchases through Maximart Co. Purchasing Center. Pricing, marketing, advertising, and human resources policies, except for hiring Minimart Co. cashier and salesmen, are decided by Maximart Co. Maximart Co. also owns 5 other stores in the same city as Minimart Co., although in different neighborhoods, and 20 other stores in other cities. All stores are managed in the same way as Minimart Co. Minimart Co. and 4 other stores were purchased 5 years ago and Goodwill was recognized. Required. What factor will Minimart Co. consider when determining if Minimart Co. meets the definition of a cash generating unit?
What factor will you consider? Now you are the CFO or you are the CEO, and based on this understanding you have, what will you consider?
Okay, for me, simply because the pricing, marketing, advertising, and human resources are done collectively at the head office, then it will be difficult to really ascertain the cash outflow associated with Minimart Co. Even though we can derive the cash inflow from Minimart Co. in the sense that the revenue coming out of that particular area can be determinable, but the cost associated with that area is difficult to ascertain. So because of this, I think it will not be treated as a cash. Because of this, it will be treated as a cash generating unit rather than as an operating segment.
I think you are creating more confusion. You said it can determine its cash flow, probably you win inflow, but its cost cannot be determined. The question is, where did you find from where do you be able to draw a conclusion that the cost cannot be determined?
Yeah, simply because the pricing, the marketing, the advertising is done collectively.
No, but that doesn't mean that the cost, that is for pricing, marketing, and also, which is what is common to every organization. It is centrally done, but that doesn't mean it's cost. Its cost means that it cannot even determine how much is the cost of products. It can't determine how much is its operating expense and some other things. Which means if you can determine, independent of others, your cash flows, regardless of the fact that you are not the one setting price, means you are somewhat independent. Okay. Your conclusion may be right, but You contradicted yourself when you said you can determine cash independently, but cost cannot be determined. I didn't get that.
Okay,
You
yeah.
based
on the
and that's, I think you need to.
I think I understand better now. That since the cash associated with that unit can be determined, so it will more likely be,
because its cash flow will be determined based on what he sells. Its cost will be determined based on what he buys and sold eventually. Therefore, even if it's not the one setting price, everybody knows that price is, okay, for example, Apple stores around the world, the price is set from the global office now. Therefore, it doesn't mean that other stores around the world are not independent outlets with respect to generating their own cash flow, inflow and outflow, independent of others. You're about saying something. Nudi, are you there?
Yes, I'm there.
I think you're about making a contribution. Any contribution?
No, sir. I'm sorry.
Okay, now
to understand the concept.
Okay, if you say no, yeah, if you say no, therefore help us look at what is presented before us as the answer to that question. And let us see whether Shegun is slightly right and whether my proposition is equally right.
Okay. And identify Minimat's cost cash generating units. An entity considers whether, for example, A, internal management reporting is organized to measure performance on a store-by-store basis. B, the business is run on a store-by-store profit basis or on a region/city basis. All Maximat coal stores are in different neighborhoods and probably have different store customer bases. So, although Minimat Co is managed at a corporate level, Minimat Co generates cash inflows that are largely independent from those of Maximat Co's other store. Therefore, it is likely that Minimat Co is cash generating units.
Okay. Do we now agree to that? I can hear our voice.
Yes.
Okay. Okay, now let's look at other considerations before we move further to testing goodwill, because we are doing this because of goodwill. Goodwill is an example, and that's where I was trying to push an arrow to, where he said subsidiary, you just generalize. Goodwill is one of those assets that vividly does not generate independent cash flows, but its cash flow can be attributed to the collection of what is being generated alongside other assets. Okay, can you take us through from the position where this stopped?
Recovery amount and carrying amount, I think is where. That's where it stopped. Yes.
Yeah. If an active market, can you begin from there?
Okay. If an active market exists for the output produced by the asset or a group of assets, these assets or group should be identified as a cash generating unit, even if some or all of the output is used internally. Cash generating units should be identified consistently from period to period for the same type of asset unless a change is justified. The group net assets less liability that are considered for impairment should be the same as those considered in the calculation of the recoverable amount for the treatment of goodwill and corporate assets. See below. Okay. Example, recoverable amount and carrying amount. 4 Ways Co is made up of 4 cash generating units. All 4 units are being tested for impairment. Assets and liabilities will be allocated to them as follows. A, property, plant, and equipment, and separate intangibles will be allocated to the cash generating unit as far as possible. B, current assets such as inventories, receivables, and prepayment will be allocated to the relevant cash generating units. C, liabilities, e.g. payables, will be deducted from the net assets of the relevant cash generating unit, provided that the recoverable amount of the cash generating unit cannot be calculated without consideration of those liabilities. IAS 36, paragraph 76. The net figure for each cash generating unit resulting from this exercise will be compared to the relevant recoverable amount computed on the same basis.
Okay, thank you. Now, we've now set a ground for us to discuss goodwill with respect to how we may be subjected to impairment. And before then, I want somebody to reiterate our understanding of what a purchase goodwill is all about. Who will volunteer?
Okay, if I can just try. We can say a purchase goodwill is a goodwill that arises from business combination. In fact, the only goodwill that is permitted to be recognized in a financial statement is not internally generated goodwill, but the goodwill that arises as a result of acquisition of a subsidiary. So this is a goodwill that exists as a result of when the purchase consideration is far higher than the net asset of that subsidiary. That is when we have the goodwill that is recognized as an asset on the face of the financial statement. And based on the provision of the standard, this goodwill is expected to be tested for impairments at least on an annual basis, as opposed to the previous IAS 22 that permitted amortization of goodwill. So this is just the little thing I can say about purchase goodwill.
Okay, who else?
Shegun has actually summarized what goodwill entails, but in addition to what Shegun said, goodwill, purchase goodwill is determined in business combination, and invariably when we consider the cost, the identifiable net assets of the subsidiary in line with in relation to the purchase consideration, and we find out that the purchase consideration is far higher than the value of the identifiable net assets. We say there is existence of goodwill, and that goodwill, according to the standard, is expected to be tested for impairment to be very sure that we value the assets and liability of the subsidiary accordingly before we establish that there is existence of goodwill. Thank you.
Thank you very much. Therefore, this provided your contributions has given us a clue about where we are going to. Okay, as you all know that purchase goodwill arose from a business combination, which is seen as the excess of the cost of business combination over the identifiable net assets of the subsidiary, which has been measured at acquisition date fair value. That amount of goodwill is what we are talking about. And such goodwill, as we all know before now, cannot be amortized as an intangible asset, but rather will have to be subjected to impairment assessment. Now, during our discussion of IFRS 3 and IFRS 10 in the process of preparing group accounts, we're able to discuss how we treat such amount of goodwill for impairment. Okay, but here we want to now discuss about how we subject goodwill to an impairment test. how do we subject goodwill to an impairment test? Goodwill is one of those assets that does not generate cash flow independent of others. Rather, they generate cash flow along with other assets as a group of assets. And in that case, IAS statistics recognize that effect and says goodwill will rather be subjected to impairment test on the basis of cash generating units to which it has been allocated and not on an individual basis, because there's no practical means to which a goodwill can be tested for impairment on a standalone basis. And that is what we wanted to discuss here. And that's why we have started our discussion with respect to what constitutes a cash generating unit. Furthermore, we'll make reference to what IFRS 3 says, that upon acquisition of a subsidiary, when goodwill arose as a result of such business combination, that goodwill must be allocated based on the internal process judgment of the management to cash generating units to which that goodwill relates, which speaks to the fact that not compulsory and not mandatory will goodwill be allocated to all cash generating units, but at least goodwill will be allocated to a single cash generating unit or more. For example, if there's no reliable basis of determining the cash generating unit that exists within a business to which the goodwill has been acquired, it then means that at least the single cash generating unit that will have existed in that situation will be the entire subsidiary as an asset. And therefore, the goodwill will be allocated in full to the entire subsidiary as an asset, which then means that the subsidiary as an asset will be taken as the cash generating unit. But there is a benchmark to which you determine your cash generating unit. One is that your cash generating unit should never fall below a group of smaller assets, which means a single asset cannot necessarily constitute a cash generating unit, because we are talking of cash generating unit as a group of assets, no matter how small as they are individually. Second, a cash generating unit can never be more than what will have qualified as a reportable segment under the operating segment of IFRS 8. Okay, and which that means that has given us the boundaries, the lower boundary and the upper boundary to which we can create a cash generating unit. And cash generating unit is usually influenced by the internal mechanism of the company. And that's why when you go back to our discussion earlier here, we emphasize something here about internal management reporting, which is performance management internally. Do you get what I'm saying now? It's critical to it. Probably by the time we discussed on operating segments under IFRS 8, you'll see how management takes decisions internally and how that influences one or two classifications that we create in terms of reportable segments. Okay, that is that. Now, let's now look further. Okay, the impairment of a goodwill must be carried out, or the test for impairment of a goodwill must be carried out at least once every year. Who can tell me why this is compulsory? Why must you subject goodwill to an annual impairment test? Even though you can do it more than once a year, but at least you must do it every year. Unlike some other assets, that impairment assessment is only subject to the existence of one or more triggers or indications of impairment. Who can answer the question?
You know, I don't know for sure, but based on what we've been discussing before, what you made us know is that any assets, especially intangible asset that does not have a definite life, you know, that has indeterminable useful life, should be tested should be tested for impairment at least on an annual basis, whether there is trigger or not. But I'm still curious to know the rationale behind that. But that is what I'm made to know as of this time.
Okay, thank you. I think you're right. But I'm just curious about your last statement, which says you don't know the rationale. The rationale is simple. Since you are not going to depreciate the assets, you are not going to amortize it. If you then don't subject it to another impairment test, you might unnecessarily be overstating the carrying amount of the assets over time, because it means you'll be carrying such an asset indefinitely at cost. Does that make sense? Does that make sense?
Yes.
Yes.
Okay. Now, how do we allocate goodwill to cash generating units? I've given you guidance, and let's look at it from the perspective of the standard. Over to you guys.
Okay, allocation of goodwill to cash generating units. Testing goodwill for impairment is difficult because goodwill does not generate cash flows independently of other assets. Therefore, we cannot calculate the recoverable amount of goodwill as an asset on its own. Instead, IAS 36 requires that goodwill must be allocated to each of the acquirer's cash generating units. Each of the acquirer's cash generating units or groups of cash generating units that are expected to benefit from synergies of business combination. Each unit to which the goodwill is so allocated should A, represent the lowest level within the entity at which the goodwill is monitored for internal management purposes, and B, not be larger than an operating segment determined in accordance with IFRS 8 operating segment. It may be impracticable to complete the allocation of goodwill before the first reporting date after a business combination, particularly if the acquirer is accounting for the combination for the first time using provisional values. The initial allocation of goodwill must be completed before the end of the first reporting period after the acquisition date. Cash generating units to which it has not been possible to allocate goodwill. As discussed at 8.2.8.1, it may not be possible to allocate goodwill to an individual cash generating unit to which it relates. In such circumstances, the unit concerned is tested for impairment whenever there is an indication that the unit may be impaired by comparing the unit's carrying amount, excluding any goodwill, with its recoverable amount. Any impairment loss is recognized in accordance with the rules set out at 9.2 IAS 36 paragraph 88. If no goodwill has been allocated to a cash generating unit, but the cash generating unit includes an intangible asset that has an indefinite life or that is not yet available for use, it will be necessary to carry out an annual impairment test for the cash generating unit if that asset can be tested for impairment only as part of the cash generating unit. In such circumstances, the rules described at 5.2 apply.
Okay, furthermore,
allocation of assets and liabilities to cash generating units. The allocation of assets and liabilities to a cash generating unit so as to establish the carrying amount of the cash generating unit should be determined on a basis considered with the way on a basis consistent with the way the recoverable amount of the cash generating unit is determined. As a general rule, the carrying amount of a cash generating unit includes the carrying amount of only those assets that can be attributed directly or allocated on a reasonable and consistent basis to the cash generating unit, and that will generate the future cash inflows used in determining the cash generating unit's value in use. And B, does not include the carrying amount of any recognized liability unless the recoverable amount of the cash generating unit cannot be determined without consideration of this liability. This allocation is consistent with the calculation of fair value less cost of disposal and value in use of a cash generating unit, which both exclude cash flows that relate to assets outside the cash generating unit and liabilities that have already been recognized in the financial statements. There will be some assets that contribute to cash flows, such as goodwill and corporate assets, which cannot be allocated to the cash generating unit on a reasonable and consistent basis. These are discussed at 8.2.8 goodwill and 8.2.9 corporate assets. In some situations, due to the nature of a particular recognized liability, it may be appropriate to include it in the carrying amounts and the recoverable amount of a cash generating unit. This will be the case when a cash generating unit could not be sold without the assumption of related liability by the buyer. In such circumstances, the fair value less cost of disposal or the estimated cash flow from ultimate disposal of the cash generating unit is the price to sell the assets and the liability together, less disposal costs. In order to be consistent and compare like items, the carrying amount of the liability should be deducted in determining both the value in use and carrying amount of the cash generating unit.
Okay, in continuation, what you need to understand also is that when you have a cash generating unit, naturally liability is supposed not to be a component. But where the cash flow you are going to be attributable to a cash generating unit, consider the cash flow of the liability, which means that cash flow also take into consideration the repayment of liability. It then means that a liability of such must be considered as a member of a cash generating unit, which means it could be the sum of the asset less the liability allocated to such a cash generating unit to determine the carrying amount of that cash generating unit, which means you work back from whatever the recoverable amount of a cash generating unit will be to determine what are the group of assets and liability, if any, that belongs to that cash generating unit. Now, in addition, let's look at a situation where liability is included in a cash generating unit.
Liability included in a cash generating unit. A company operates a mine in a country where legislation requires that the owner must restore the site on completion of his mining operations. The cost of restoration includes the replacement of the overburden, which must be removed before mining operations commence. A provision for the cost to replace the overburden was recognized as soon as the overburden was removed. The amount provided was recognized as part of the cost of the mine and is being depreciated over the mine's useful life. The carrying amount of the provision for restoration cost is 500 CU, which is equal to the present value of the restoration costs. The entity is testing the mine for impairment. The cash generating unit for the mine is the mine as a whole. The entity has received various offers to buy the mine at a price of around 800 CU. This price reflects the fact that the buyer will assume the obligation to restore the overburden. Disposal costs for the mine are negligible. The value in use of the mine is appropriately 1,200 CU, excluding restoration costs. The carrying amount of the mine is 1,000 CU. The cash generating unit's fair value loss cost of disposal is 800 CU. This amount considers restoration costs that have already been provided for. As a consequence, the value in use for the cash generating unit is determined after consideration of the restoration costs and is estimated to be 700 CU, that is 1,200 CU less 500 CU. The carrying amount of the cash generating unit is 500 CU, which is the carrying amount of the mine 1000 CU less the carrying amount of the provision for restoration cost 500 CU. Therefore, the recoverable amount of the cash generating unit exceeds its carrying amount.
Okay, thank you very much. Now let's now look at how do we test a cash generating unit to which goodwill is allocated for impairment. Now, practically, we'll demonstrate that understanding. Okay. Now, remember, we discussed this in the course of group accounts. Okay, and we more or less told you that we will rely on the requirement of IAS 36. What it is this. Let's assume that there are 3 cash generating units in a business, and you allocated the goodwill to the entire 3. Let me say 40, 40, 20. Now, each cash generating unit will be tested for impairment separate from another. If you test cash generating unit A for impairment, if there's no impairment, there's no problem. The goodwill of 40 in that, we have no problem. If you test cash generating unit of B for impairment, the goodwill incorporated there is 40 also. And there's an impairment loss of that cash generating unit, being the fact that the carrying amount of that cash generating unit, including goodwill, is more than the recoverable amount of that cash generating unit. Therefore, let's assume that 30 is the impairment loss in that cash generating unit, but 40 is the amount of that goodwill. That 30 will be used to reduce the 40 of goodwill first to 10, which means nothing will be allocated to other assets because goodwill has first of all absorbed the 30, still leaving out 10. But let's say the impairment loss is 50. Goodwill will first of all be written off because goodwill is an intangible asset which you believe will be drawn from the synergy. And if there's a synergy attributed to that collective asset, there shouldn't be impairment loss, which means the synergy no longer exists in principle. And in that regard, the entire 40 have to be written off against that 50, which means there's still 10. That 10 will now have to be allocated over the remaining assets, subject to certain conditions, which we are going to look at. Okay, that is how we subject it to what? Impairment. Okay, that is that. Now, can somebody read this up for us before we demonstrated with practical illustration?
Okay. Yeah. Testing cash generating units with goodwill for impairment. Testing goodwill for impairment is difficult because goodwill does not generate cash flows independently of other assets. Therefore, we cannot calculate the recoverable amount of goodwill as an asset on its own. Instead, IAS 36 requires that the goodwill must be allocated to each of the acquirer's cash generating units or group of cash generating units that are expected to benefit from the synergies of the business combination. Each unit to which the goodwill is so allocated should A, represent the lowest level within the entity at which the goodwill is monitored for internal management purposes, and B, not be larger than an operating segment determined in accordance with IFRS 8 operating segment. It may be impracticable to complete the allocation of goodwill before the first reporting date after a business combination, particularly if the acquirer is accounting for the combination for the first time using provisional values. The initial allocation of goodwill must be completed before the end of the first reporting period after the acquisition date.
I think we are familiar with that when we discussed on provisional values during the what we call measurement period under IFRS 3. Okay, and this is just to re-emphasize that. And the measurement period is the first 12 months from the date of acquisition in which an investor has obtained the control of an investee. And that period is a period in which you are expected to have been able to reasonably ascertain the fair value of all identifiable assets and liabilities, regardless of whether they are in the books or not of the acquired business. Now, in that case, let's look at this practical illustration to start our engagement on how we test goodwill along with other assets as a cash generating unit for impairment assessment. Now, can somebody read out this illustrative question and let's try to provide solution to it?
Okay, illustrative examples. A cash generating unit comprises the following. Building is 30 million, plant and equipment 6 million, goodwill 10 million, current assets 20 million. The total is $66 million. Following a recession, an impairment review has estimated the recoverable amount of the cash generating unit to be $50 million. How do we allocate the impairment loss? You are muted, sir.
Okay, thank you. I said before I provide practical demonstration of the solution, can somebody give us a clue on it?
Okay, based on understanding of the presentation that is ongoing, looking at all the cash generating units from building up to the current assets. The total cash generating unit is 66 million, while the recoverable amount is 50 million. Invariably, we can see that there is impairment loss of 16 million. There is impairment of loss of 16 million. And before we start allocation, what we'll consider first is the goodwill. We are going to start the deduction from goodwill, meaning that goodwill that shows 10 million will suffer the whole lot of impairment loss, meaning our loss will be reduced from 16 million to 6 million. That means the entire goodwill will suffer impairment loss. Then the other allocation, 6 million, allocation of 6 million can now Mr. Muiwa can give us guidance as per the allocation.
You are still muted, sir.
Okay, thank you. I said, let me bring out the variables first. We have building, 30 million, I'll write it in full. We have plant and equipment. We have goodwill, and we have current assets. I'll figure in thousands of dollars. Okay, 30 million. This is 6 million. This 10 million. And this 20 million. Okay, now step 1 of my suggested solution is, we are told here that this comprises of non-cash generating units. Okay, now step 1 there is to say that is the cash generating units CGU impaired? I'll replace the asset with CGU. Is it impaired? How do I know? I need the carrying amount. And I need the recoverable amount. What is the carrying amount? This is the recoverable amount. Let me put it in capital. Recoverable amount of CGU. Carrying amount of CGU. The carrying amount is as shown below, and this is the recoverable amount. Okay, the recoverable amount is 50 million. And the carrying amount is what is here. Which then means that I'll come here to say, what is the carrying amount? Is the sum of all of these amounts. Which is 66 million. Now, the recoverable amount is 50 million. The question then is, upon the test, is CGU impaired? It says yes. Now, if it is yes, by what amount is 16 million? And therefore, what do we do? Is to go to step 2. Step 2 is allocation of the impairment loss to components of the CGU. And how do we do that? We bring the components. These are the components. We'll bring the carrying amount out. And we ask ourselves, will impairment loss be allocated I'll select it later. If it's yes, therefore, what is the allocated impairment loss? And what is the new carrying amount? Which impairment? Okay, now the initial carrying amount sum up to how much? 66. Now the first question we ask ourselves is, even though this asset belongs to calculating unit, based on this information, will they be subjected to impairments, allocation of this calculating unit? I will explain one by one. Building and plant are not current assets, and they will surely fall under that, subject to an exception, which I'm going to explain later. Goodwill will surely fall, but current assets barely will fall under it. Who can tell me why? Why is it more prone for an impairment assessment, impairment loss on the calculating unit will not affect current assets or element of current assets? Who can tell me why?
If I may try, I think current assets are assets that are expected to be realized within a short period of 1 year.
I didn't hear you well.
I said they are assets that are expected to be realized within a very short period.
Yeah, but that doesn't mean, but probably because current assets will have been subjected to one form of impairment or the other. Example is inventory. It has been impaired in line with IAS 2 with respect to write down. Receivables have been subjected to impairments under IFRS 3, that's IFRS 9, and it's a separate asset that generates capital impairment of others. Okay. Similarly, when you look at income taxes, it's excluded because the requirement falls under IAS 12. When you look at contract assets, it's excluded because the requirement falls under IFRS 15 and the likes. And barely can you find yourself having current what assets in that light. Okay, which means if that is the case, I'll simply come here and put 0 so that at no point in time will I consider this at all. Okay, now what happens is there is this loss of 16. The thing is that we allocate allocate the impairment loss so that it reduces goodwill to zero, if any. In this case, goodwill is 10 million, and we have 15 million. Therefore, the entire goodwill will first of all go off. Now, what is left?
Could you please check your audio, sir? Like, I'm struggling to hear you.
Okay. What is left is $6 million. As loss. Initial amount of impairment loss was 16 million. What you allocated to goodwill was 10 million. Therefore, what is left is 6 million. And this 6 million will then be allocated to goodwill and plant and equipment on a pro rata basis as loss. Okay. What is the kind amount? 30 and this. Therefore, what is the sum? 36. Now, what is the ratio? Ratio of 30 to 36. That gives me about 83.3%. Let me convert it to percent. And I did the same thing. When you sum it up, it should give you 100%. And on that basis, we use that basis to allocate this remaining 6 million, which means you give 5 million and give 1 million in that ratio. From there, I can leave this 5 million and leave this . And that is it. Invariably, we have allocated the goodwill and the impairment loss, first to goodwill and others on a pro rata what basis. Invariably, what is the revised or the new carrying amount after impairment? 25, 5, 0, and 20. And altogether, that gives 50. Does that make sense? Does that make sense to us?
Absolutely.
Yes, sir. Does.
Yes. That's what we are saying. But again, if you follow my words, I'm putting exceptions there. I'm putting a clause. Because it will not exactly be what I've done, because there are some other conditions we need to meet. And we are going to discuss that also. But on a platter of gold, on a simple basis, this is the first step towards allocating goodwill, allocating impairment loss to cash generating units. And I will first of all affect goodwill before affecting other assets. Does that make sense? Okay. Let me copy this and try and put it in our notes. Any other question? Any other question? I can't hear you guys.
Not for now.
Okay, can somebody read this?
Okay, please, I want to ask a question.
Okay, what's your question?
Okay, in a situation whereby we have an intangible asset, let's say maybe software platform or whatever, and in the actual, even though it belongs to this cash generating unit, but in actual fact that not suffered impairment, should we still impair it on this pro rata basis?
Repeat your question and speak louder, sorry.
Okay, what I'm saying is that in this cash generating unit, there is a particular intangible asset that has not been impaired at all, that we could see that even though there is a general impairment within this cash generating unit, but there's this specific intangible asset that we can say is not impaired. Possibly it had even appreciated. So should we still go ahead and allocate impairment to it?
Thank you. One of those conditions is that assets that can generate cash flow independent of others will not fall under this cash generating units. Do you agree?
Yes.
If that intangible asset can generate cash flow independent of others, it will not fall under the CGU. But once it falls under the CGU, it means it cannot generate cash flow alone. And along with others, It's still not proving that weight that would not have made that CGU to have been impaired. For that CGU to have been impaired, it means those values we top the intangible as is not necessarily drawing such a value to others in order to generate the cash flows. It's like, look at Messi. Messi is a fantastic player. He's the world best, as the case may be. But when he plays with Argentina, the value technically is eroded because with his one footballer or anything we call it, that impact is not being felt by winning cups, by getting to significant level of competition, struggling to even qualify from Copa America to World Cup. Therefore, we now say the intangible value of Messi is rubbing positively so that the value of the Argentine team is not impaired. Does that make sense?
Yeah. It does.
Does that make sense?
Yes, yes, it makes sense.
Can you read this and let's have a few minutes break? The last sentence that supports the solution.
Okay. As stated in section 3.2 above, the order of write-off is that the loss will be applied first against the goodwill and then against the tangible non-current assets on a pro rata basis. The current assets are considered to be stated at fair value and hence no impairment loss is allocated to them. This is covered further in the next session. After writing off the goodwill, the balance to be allocated is $6 million. This is prorated over the total $36 million, over the total of $36 million for the remaining non-current assets at a rate of $1 million per $6 million.
Okay. Thank you very much. Okay, let's continue to reiterate some of those things we discussed. Sheldon, over to you.
Okay, goodwill. Allocating goodwill to cash generating units. For the purpose of impairment testing, goodwill acquired in a business combination shall, from the acquisition date, be allocated to each of the acquirer's cash generating units or groups of cash generating units that is expected to benefit from the synergies of the combination, irrespective of whether other assets or liabilities of the acquiree are assigned to those units or groups of units. Each or group of units to which the goodwill is so allocated shall A, represent the lowest level within the entity at which the goodwill is monitored for internal management purposes, and B, not be larger than an operating segment as defined by paragraph 5 of IFRS 8, operating segments before aggregation. Corporate assets. Corporate assets include...
Sheldon.
Yes, sir.
Sorry, can you start over again? The network was bad the other time, so that it will have affected the recording. Can you start all over again?
Okay. Goodwill. Allocating goodwill to cash generating units. For the purpose of impairment testing, goodwill acquired in a business combination shall, from the acquisition date, be allocated to each of the acquirer's cash generating units or groups of cash generating units that is expected to benefit from the synergies of the combination, irrespective of whether other assets or liabilities of the acquiree are assigned to those units or groups of units. Each unit or group of units to which the goodwill is so allocated shall A, represent the lowest level within the entity at which the goodwill is monitored for internal management purposes, and B, not be larger than an operating segment as defined by paragraph 5 of IFRS 8, operating segments before aggregation. Corporate assets. Corporate assets include group or divisional assets, such as a building of the headquarters or a division of the entity, EDP equipment or a research center, the structure of an entity The structure of an entity determines whether an asset meets this standard's definition of corporate assets for a particular cash generating unit. The distinctive characteristics of corporate assets are that they do not generate cash inflows independently of other assets or groups of assets, and their carrying amount cannot be fully attributed to the cash generating unit under review. Because corporate assets do not generate separate cash inflows, the recoverable amount of an individual corporate asset cannot be determined unless management has decided to dispose of the asset. As a consequence, if there is an indication that a corporate asset may be impaired, recoverable amount is determined for the cash generating unit or group of cash generating units to which the corporate asset belongs, and is compared with the carrying amount of this cash generating unit or group of cash generating units. Any impairment loss is recognized in accordance with paragraph 104. In testing a cash generating unit for impairment, an entity shall identify all the corporate assets that relate to the cash generating unit under review. If a portion of the carrying amount of a corporate asset A can be allocated on a reasonable and consistent basis to that unit, the entity shall compare the carrying amount of the unit, including the portion of the carrying amount of the corporate asset allocated to the unit within its recoverable amount. Any impairment loss shall be recognized in accordance with paragraph 104. B, cannot be allocated on a reasonable and consistent basis to that unit, the entity shall, kindly scroll up, please. Okay, the entity shall, 1, compare the carrying amount of the unit, excluding the corporate asset, with its recoverable amount and recognize any impairment loss in accordance with paragraph 104. 2, identify the smallest group of cash generating units that includes the cash generating units under review and to which a portion of the carrying amount of the corporate asset can be allocated on a reasonable and consistent basis. And finally, compare the carrying amount of that group of cash generating units, including the portion of the carrying amount of the corporate asset allocated to that group of units, with the recoverable amount of the group of units. Any impairment loss shall be recognized in accordance with paragraph 104.
Okay, thank you very much. We discovered that everything we've discussed so far is what you have narrated once again. Now, furthermore, we will further extend our discussion on the accounting treatment for impairment loss on cash generating units. Remember, I told you that the one I displayed earlier is subject to certain exceptions or conditions, and we're going to see those conditions again as we reiterate on what we have said earlier. Now, there are some technical issues that we need to take cognizance of in a situation where you will be able to recognize further allocation of impairment loss from some assets due to one factor or the other. One of those factors is what we have discussed earlier. 1, a situation where an asset generates cash independent of others, such assets will have to be excluded. Asset that has been specifically, by its own standards, tested for impairment outside the scope of IAS 36 will also not fall under the basis of allocation. Also, for those assets that falls under IAS 36 to which impairment loss will be allocated, such allocation of impairment loss will be subject to the fact that it will not make us to recognize lower than the amount that you would have recognized based on the highest value in use. And what is the highest value in use in this case? In allocating such an impairment loss, you will find out that the carrying amount of an asset should at no point in time reduce the asset's amount below its highest of fair value less cost of disposal, value in use if determinable, or zero value, which means 1, allocation of impairment loss should not take the carrying amount to negative. 2, should not take the amount below the higher of the fair value less cost of disposal and the value in use, which means should never take the asset below its recoverable value as an independent asset. What then happens if we have element of impairment loss that cannot be allocated further because of all of these conditions? the standard says you then need to recognize a liability, which means such unallocated impairment loss applicable to cash generating unit will be deemed to be a liability against that cash generating unit, which will now have to be recognized in our financial statement. But let us look at it from the perspective of the standard. We'll look at it from where we started from and where we extended it to based on these exceptions and conditions. Over to you.
Okay. Accounting treatment of an impairment loss. If and only if the recoverable amount of an asset is less than its carrying amount in the statement of financial position, an impairment loss has occurred. This loss should be recognized immediately. A, the asset carrying amount should be reduced to its recoverable amount in the statement of financial position. The impairment loss should be recognized immediately in profit or loss unless the asset has been revalued upwards, in which case the loss is treated as a revaluation decrease. After reducing an asset to its recoverable amount, the depreciation charge on the asset should then be based on its new carrying amount, its estimated residual value, if any, and its estimated remaining useful life. An impairment loss should be recognized for a cash generating unit if and only if the recoverable amount for the cash generating unit is less than the carrying amount in the statement of financial position for all the assets in the unit. As we mentioned in section 3.2 above, when an impairment loss is recognized for a cash generating unit, the loss should be allocated between the assets in the unit in the following order. First, to the carrying amount of any goodwill allocated to the cash generating unit. B, then to all other assets in the cash generating unit on a pro rata basis. If an individual asset within a cash generating unit can be specifically identified as being impaired, for example, because they are damaged or have been obsolete, then the carrying amount of those assets should be reduced first. In allocating an impairment loss, the carrying amount of an asset should not be reduced below the highest of its fair value less cost of disposal, its value in use if determinable, and zero. Any remaining amount of an impairment loss should be recognized as liability if required by other IFRS standards. Allocating an impairment loss to goodwill is further complicated by the choice in IFRS 3 business combination to value the non-controlling interest at fair value or at the proportionate share of net assets.
Okay, now we'll get to that level. Okay, what that level speaks to is that impairment loss on goodwill. Remember, we have what we call the partial goodwill and the full goodwill. Now, how do we test for impairment loss on goodwill when the goodwill recognized is a partial goodwill as compared to a full goodwill? We'll get to that level. What does the standard says in line with IFRS 3 and also in accordance with IAS 36? We're going to discuss that. Secondly, the liability will only be recognized for the unallocated impairment loss associated with CGU if any other standard permits it. Example of standard that might require such recognition might be IAS 37 and any other standard that might have one or two things to do with such an asset or asset that constitutes that CGU. Okay, that is on that premise. Now I'll have a question that I'm going to present to us, which is a practical question, and we'll read the question, we'll deliberate on it, and probably prefer a solution through our usual modeling. Okay, the question is as thus. Can somebody read?
A company that extracts natural gas. Okay, practice question, take it again. A company that extracts natural gas and oil has a drilling platform in the Caspian Sea. It is required by legislation of the country concerned to remove and dismantle the platform at the end of its useful life. Accordingly, the company has included an amount in its financial statement for removal and dismantling costs, and is depreciating this amount over the platform's expected life. The company is carrying out an exercise to establish whether there has been an impairment of the platform. A, its carrying amount in the statement of financial position is 3 million. The company has received an offer of 2.8 million for the platform from another oil company. The bidder will take over the responsibility and cost for dismantling and removing the platform at the end of its life. C, the present value of the estimated cash flows from the platform continued use is 3.3 million before adjusting for dismantling costs. D, the carrying amount in the statement of financial position for the provision for dismantling and removal is currently 0.6 million. What should be the value of the drilling platform in the statement of financial position, and what, if any, is the impairment loss?
Now we'll put it on the model, and first thing we're going to do is to extract out the information one by one before we take a decision. Okay. Okay, these are the information we have. Fair value less cost of disposal is how much? 3 million? No, that's 2.8 million. Okay, the kind amount of the assets. In the balance sheet is 3 million. Okay, the present value of the cash flow from the use of the assets is 3.3 million. And the kind amount of the provision for dismantling costs in line with IAS 37 is 600,000. All figure in thousands of dollars. Let me brush it off. Okay, now who can now take us through, since we've extracted the information out the way we have it here? What should we do in this regard? Who will provide the guidance? Now, what we are trying to do is what should be the value of the drilling platform? Okay, step one is to determine the recoverable amounts. And that is the higher of fair value less cost of disposal. which in this case is 2.8. And B, value in use of the drilling platform. Now, the value in use of the drilling platform as given to us was 3.3 million. That is the present value. But that amount has not taken into cognizance that there is a dismantling provision. And if you remember under IAS 37, and also if you remember under IAS 16, part of the cost of an asset includes cost attributed to restoring the asset or any other associated asset to its right state of use after the useful life of the platform. In that situation, what happens is that you have to recognize as part of cost of an asset the present value of the restoration cost or dismantling cost or what they call the abandonment cost. And in that situation, that's what has created that liability, which is associated to the asset and which must be deducted from the independent cash flow associated to that asset before we arrive at the value in use. Which means value in use invariably is a net present value, which means it is the difference between the present value of the cash flows, which is 3.3, and 2 less 2. The carrying amount of the dismantling cost of the liability. Let me just put liability for short because of space. And that speaks to one of those things I've discussed about allocating a liability to a cash generating unit. And in that case, the liability is 600. Invariably, what do we have? We have the sum of this would give me 2.7. The question is, what is our recoverable amount now? Recoverable. The drilling platform is which was the higher maximum of 2.8 and 2.7, and that is 2.8. Okay, take notes. Step 2. Is to determine the impairment loss, if any. And what do we do to determine impairment loss? Remember, I can copy it from here. Now, what is the current amount of the drilling platform? And what is the recoverable amount of the drilling platform? The carrying amount is given to us in the question as 3 million. And the recoverable amount is as determined in step 1, which is 2.8. Therefore, what do we have? We have 200,000. Therefore, step 3, which will assist us in answering the question, what is the new carrying amount of the drilling platform post impairment? And that will be the carrying amount less, I think I have it somewhere. Have we not done it somewhere? Okay, we've not done it somewhere. It will now be the carrying amount, which is USD. Sorry, these figures are in USD. It will be our USD, which is the carrying amount of the platform less the impairment loss. What's the carrying amount? The carrying amount is 3 million. What's the impairment loss? 200,000. And that gives us 2.8 million. Does that make sense to us? Now we have demonstrated where a liability might form part of an asset or part of a cash generating unit for the sole purpose of carrying out an impairment assessment. Okay. Any question? Now let's look at another short exercise. Another practice question. Can someone read this?
Okay. A company has acquired another business for $4.5 million. Tangible assets are valued at $4 million and goodwill at $0.5 million. An asset, the carrying amount of $1 million is destroyed in a terrorist attack. The asset was not secured. The loss of the assets without insurance has prompted the company to assess whether there has been an impairment of assets in the acquired business and what the amount of any such loss is. The recoverable amount of the business, a single cash generating unit, is measured at $3.1 million.
Okay, who can answer that? We'll provide guidance to that.
Okay, I think it's still going to follow the same pattern. Like first, we have to determine the recoverable amount, which is the area of fair value, less cost to sale, and the value in use. So in this instance, the value in use has been impaired by, has suffered a kind of loss, which is 1 million. That has to do with the uninsured asset that was destroyed. So that is going to reflect in our computation. And whatever we now get as the recoverable amount, we have to like compare it with the carrying amount of the business. So anything we have as the impairment will now be allocated to, or another way I'm also looking at it is if we just compute the fair value less cost to sale and the value in use, then we compare it with the carrying amount. So within that impairment that we're going to arrive at, it will reflect this 1 million that was destroyed, and we charge it over the asset. So that means that the asset that have been destroyed, that 1 million, will be derecognized in total, and whatever is remaining will be allocated to the other asset on a pro rata basis.
Remember that what we'll be proposing is what has been generally acceptable. Okay? Therefore, there's a limit to we trying to more or less corner the process. Now, it's very logical. Let me narrate it. You acquire a new business worth $4.5 million. When you are able to attribute your purchase consideration, you are able to trace $4 million to the fair value of the tangible assets acquired, which means the excess over that is your goodwill of $500,000. If you remember our discussion under IFRS 3 on business combination. Now, the assets that has a kind amount of 1 million out of that tangible assets was destroyed as a result of terrorist attack. And unfortunately, that particular asset was never insured. And that asset belongs to part of the tangible assets of the newly acquired business. Now, the loss of the asset without insurance has prompted the company to reassess whether there's an impairment of other assets along with that asset in the business as a whole, because that asset is instrumental and critical to the business as a whole, because asset of 1 million out of 4 million is about 25% is critical, is material. And therefore, let us reevaluate the entire business as a CGU, if there might be other impairment losses. Now, when we did that, we came to a conclusion that the recoverable amount of the CGU as a single business is 3.1 million. Therefore, what do you have to do? We will now compare the consideration we paid at acquisition, which is 4.5 million, being the worth of the business, with 3.1 million. It then shows us that we have an impairment loss of 1.4 million. But the question is, how do we allocate this 1.4 million? Now, what will have come to some people's mind is that first you allocate to Goodwill. But the answer here will be no. Why? Because you allocate to Goodwill first only when you have no visible information about specific loss that has been incurred by a particular asset within the CGU. For example, in this case, which means there is a total loss arising from the terrorist attack on a particular asset of 1 million. That asset no longer exists. Therefore, you must first of all write that one off. Which means out of the 1.4 million, 1 million of it is solely attributed to the asset that had experienced terrorist attack. and that is off. It now remains 400,000. That 400,000, we now ask ourselves, do we have goodwill? The answer is yes. How much do you have in goodwill? 500,000. That means that 500,000 in goodwill is enough to absorb the remaining 400. If not enough to absorb the remaining 400, any excess there will now be allocated to other tangible assets in that case. Which then means that in that case, we reach a conclusion that 1 million of the 1.4 is allocated to the damaged asset to terrorist attack, and 400,000 is allocated to goodwill. Can you read out the solution?
Okay. Solution. There has been an impairment loss of $1.4 million. That is $4.5 million minus $3.2 million. The impairment loss will be recognized in profit or loss. The loss will be allocated between the assets in the cash generating unit as follows. A loss of $1 million can be attributed directly to the uninsured asset that has been destroyed. B, the remaining loss of $0.4 million should be allocated to goodwill. The carrying amount of the asset will now be $3 million for tangible assets and $0.1 million for goodwill.
Does that make sense now?
Yes.
Any other question? Okay, now let's now look at propriety of goodwill. We have full goodwill, we have partial goodwill. From all what we have been saying before, by adding goodwill to the CGU for impairment test, presume that the goodwill is a full goodwill. But what if it was a partial goodwill? It then means that that goodwill have to be grossed up first before we can consider it as part of the CGU for the purpose of impairment. Or because you are not recognizing 100% value of the goodwill, rather you are recognizing goodwill solely attributed to the parent. But in the consideration for impairment assessment, the goodwill that's supposed to be allocated to CGUs must be full what? Goodwill, which means if you have chosen an accounting policy that does not recognize full goodwill, for the sole purpose of impairment, you first of all gross it up to add it to the CGU, determine impairment loss applicable to the goodwill, and anything you get from that as impairment loss chargeable to goodwill, you also now prorate it to what affects you as a parent entity. But what we are saying is that at every point in time, when you are to subject goodwill to impairment, and if it's not full goodwill, you must always gross up that goodwill to add to the carrying amount of other cash generating units before such can be subjected to impairment. And any amount of impairment loss allocated to that will now have to be prorated to the portion that is attributable to the parent entity. Let's look at a practical scenario or consideration as given by the standard. Okay, can somebody take this up for us?
Okay, gross up of goodwill for impairment testing when components of non-controlling interests that are present ownership interest arising in a business combination are measured at their proportionate interest in the net identifiable assets of the subsidiary. Example, entity A acquires 80% of entity B in a business combination. On acquisition, entity A chooses to measure the components of non-controlling interest, NCI, that present ownership interest in entity B at their proportionate interest in the net identifiable assets of entity B. This results in goodwill of 20,000 CU, which is allocated in its entirety to entity B for the purpose of impairment testing under IAS 36. IAS 36 requires the carrying amount of goodwill to be grossed up to include the goodwill attributable to the NCI. The adjusted carrying amount should then be compared with the recoverable amount of entity B to determine whether there is impairment. IAS 36 does not prescribe a method for grossing up goodwill to include the amount attributable to NCI when the component of NCI that are present ownership interest arising in a business combination are measured at the proportionate interest in the net identifiable assets of the subsidiary. Example 7A in the illustrative examples accompanying IAS 36 demonstrates a mathematical gross up based on ownership interests. Therefore, in the above example, it would be appropriate to gross up goodwill to 25,000 CU, being 20,000 CU times 100 divided by 80. However, in the absence of guidance to the contrary, entity A could gross up goodwill based on the fair value of NCI at the acquisition date. That is, the amount of goodwill that would have been recognized if NCI had been measured at fair value at the acquisition date, if that information can be determined reliably.
Okay, thank you very much. Okay, that has provided us some guidance. Now, I'll give you a practical stuff, or probably I might use this information here to demonstrate one thing or the other. Okay? Now, let me go to our Excel model sheet. Now let's look at a situation where, let's give ourselves this situation. Let's say goodwill at acquisition. Okay. Cost of combination. Now we have two models. We have the one that is measured at fair value, where NCI is measured at fair value, and when the other one is measured at proportionate share.
Yeah, of net assets.
Okay. Okay, we have parents' equity investment. In subsidiary. Loss is, let me put it in there, is 1 million, which is the same thing for the second methodology. Where we have the difference is NCI.
Yes.
Now, NCI here is fair value, and the fair value has been determined. You all know how to determine the fair value, but the fair value has been determined at, let me say, 200,000. And let's say 240,000. And let's say the proportionate share. Remember, the ratio of parent to NCI. Let me put somewhere here. Stake, percentage stake in subsidiary. Let me put it somewhere here. parent and non-controlling interest. Everything must always sum up to 100%. And if the parent is, let's say, 80%, the subsidiary will be 1 minus 80%, which is 20%. Okay? Therefore, proportionate share, which is B, is 20% of the net asset value, which we don't know yet. We'll get that. We sum this up, all things being equal. We can call that A. Now, we need the fair value of identifiable net assets acquired. Which comprises of the share capital of the subsidiary, the pre-acquisition reserve, for simplicity's sake, now say the share capital is, let's say it's 500,000. It's the same, regardless of the methodology. The methodology only relates with valuing NCI. That's where the issue of that methodology comes into play. Okay, now let's say this is 600,000, not 6,600,000. Therefore, I can sum it up and say, this is this, and this is this. B. Now, what is my goodwill? My goodwill at acquisition, or my acquired goodwill, as the case may be, is a difference between this and this. And I've not gotten this because I now need to come, this is 1.1. I'll come here, 1.1 million. Therefore, what is 1.1 million? The product of 20% and 1.1 million will give me 220. Therefore, the goodwill as acquired is this. Now, what are we to do? We now want to test it for impairment. Now, let's say from the information available, additional information subsequent to acquisition is as follows. One, the goodwill is allocated to a single CGU. Okay? Two, the CGU has since been impaired. Three, the recoverable amounts of the CGU is, let me say, 10.5 million. 4, the carrying amounts of the CGU, excluding goodwill, as at the reporting date, let me say 31st December 2020, was 11 points. That's it now. Let me say 10.6 million. Okay, I'm trying to construct that question. Okay, question required. What will be the amount of impairment loss allocated to goodwill even NCI was measured at acquisition at fair value, the equity instrument, or B, NCI was measured acquisition at a proportionate share of the net assets. Therefore, these are the questions. Okay. Now, what do we do? Now, there are different ways of looking at it, but I'll try and simplify it. And take note, if my objective is not achieved, I might change the figures in the question because I'm trying to achieve an objective. Now, step one. Step one. Is to determine the cash generating what? Units. The kind amount. To which the goodwill has been allocated. Okay. Now there are two methods. Method one is to gross up using the percentage. Method two is to gross up using what the fair value will have been if you have measured it at fair value. I'm going to see the consequence of the two methods. Now the kind amount component of the CGU, tangible assets and goodwill. Method one, method two. This method one and two are for gross up, which was read not quite long. Now, the tangible assets is 10.5 million, no, 10.6 million. $10.6. The full goodwill was 140. C notes. C technical notes. Now, this one will be grossed up. Grossed up by the percentage of NCI of the periods. Now, what it means is this. The goodwill we have is 120. Okay, and we need to gross it up to 100% because it represents 80% if you remember proportionate share. The standard says you can make, the standard does not give guidance, but practice says that you can gross it up to the percentage or you go and estimate what the fair value of NCI is, which we already have here. That's why you find out that the fair value is what has produced this goodwill here, and that's why I was not bothered. And take note, this acquisition took effect at 1st of January 2020. Therefore, what will I do? I'll gross up. Gross up means this 120 represents 80%. To gross it up means divided by 0.8. That is, 0.8 is divided by the 80% here. Which means by grossing up is 150. But if I decide to go by way of fair value, it is 140. Any of it is used. But for simplicity, especially in examination sake, we always go for gross up by way of percentage of the periods. And that will form the accounting policy. Okay, take note, gross up by 80% of the periods. And let me try and show the gross up, which equals to 120,000 divided by 80%. That's how we got it for record's sake. Okay, that is that. Now, once you do that, you arrive at this. At this. This is now the carrying amount, including carrying amount of CGU, including Goodwill. Now, what do? You now compare this, step 2. Determine the impairment loss on the CGU, if any. How do you do that? You compare the carrying amount, which I got here, with the recoverable amount. Of the CGU. Now, this is obtained here. And this is given to us as 10.5 million. When we compare sorry. Now, when you compare the maximum of the 0 and the difference, it should give you amount of impairment loss. Okay, now I'll have to change the information because I'm not able to achieve what I want to achieve. Therefore, I think I've given more value to that. Let me say this is 10 points. I gave 10.6 before. Let me say it's 10 points. Or let me increase the recoverable amount. Let me increase the recoverable amount to 10.8, no, 10.7. Let me say it's 10.68 or 66. Okay, 10.66. Now, yeah, I've achieved what I want to achieve, 10.66 million. Now, this is the impairment loss. But remember, this impairment loss recognized is grossed up. Or let me say it's gross. You don't determine impairment loss on a net basis, it's gross amount. That's why we have to gross up the goodwill when it comes to partial goodwill. Remember, this is full goodwill. And this other goodwill is a partial goodwill. Because impairment is assessed on a gross basis. Now, what do we do? Since the goodwill is 140 and 150 here, you find out that the entire impairment loss will be allocated. The entire impairment loss of the CGU will be allocated to goodwill, since the carry amount as gross stock of the goodwill is sufficient to absorb all of the impairment losses of the cash generating units, CGU. Therefore, now the technical note below is the gross up by 80% I've made up here. Okay, I think I don't need to even put that. Let me just take it off, since I put it in a separate line. Doesn't make, okay? These are goodwill as a whole. Let me try and create a line for it. Okay. Now, I've tried to show you that is the same goodwill. Okay. Now, if you are now to that step 2, step 3. That accounting policy of the group is to measure non-controlling interest NCI at proportionate share of net worth assets. Therefore, the consolidated goodwill after impairment recognition will amount to We'll see it now. Now, what I'm trying to show you is how you subject impairment and goodwill or partial goodwill to impairment test on the premise that NCI is measured at proportionate what share to see the effect of this gross up. Okay. Now, what do? You know, we are looking at method 1, method 2. Remember, method 1, method 2, I'm going to put it somewhere so that you know what method 1 is. Method 1 is to gross up using the fair value. Method 2 is to gross up using the percentage. Okay. Now, what do we have? The goodwill, partial. The partial goodwill, if you remember, is 120. Whether method 1 or method 2, we are using the same partial goodwill. Okay, less impairment loss. Now, the impairment loss will now be a function of the prorate. Method 1, you find 80% of it. 80% of 80,000. Method 2. Method 2, you find 80% of 120. Therefore, 80%, remember, of 80,000, that's 64. This 120, this 90. And 80% of 90. Which means you are only taking the share because you are not recognizing the full goodwill. But in testing the asset goodwill for impairment, you test it for impairment at the gross level. And therefore, what do we have? The current amount of the goodwill will virtually be 56 or 48. And that is the position. Does that make sense to you?
Yes, it does.
But in examination, you will have information about the fair value. Therefore, don't bother to use method 1. Method 2 of gross up is what is available for you, which is gross up using the percentage. Therefore, let me try and smuggle method 1 and method 2 into this. Method 1, what is method 2? Okay. Method description. Method 1 is grossing up of goodwill through the adoption of fair value of NCI measure. By method 2, grossing up the partial goodwill with the parent's percentage stake in the subsidiary. I'll put the preferred method. I'm putting the preferred method for examination purposes. Okay? Even in practice, because otherwise you now have to be keeping measure of value of NCI. Take note of this. Any question? Okay.
Okay. Consolidated.
Let me put it up as part of our notes. Okay, now let's read further other practical applications with respect to Goodwill.
Okay. Application of IAS 36 when non-controlling interests arise subsequent to the business combination and are measured at the proportionate share of net assets of the subsidiary. IAS 36 does not apply to situations in which the non-controlling interests arise from transactions or events other than a business combination, e.g. a decrease in ownership in a subsidiary without loss of control. Even if the components of non-controlling interest that are present ownership interest are measured at the proportionate share of the subsidiary's net assets. This is because the purpose of IAS 36 is to ensure consistency for the purpose of impairment testing between the goodwill included in the recoverable amount of a cash generating unit and the goodwill included in the carrying amount of that cash generating unit. The cash flows used to determine the recoverable amount of a cash generating unit reflects 100% of its activities. As a result, the recoverable amount includes 100% of the goodwill attributable to the cash generating unit. When components of non-controlling interests that are present ownership interests arise as a result of a business combination and are measured at the proportionate share of the acquiree's identifiable net assets, The goodwill recognized in the consolidated financial statements reflects only the parent share of the goodwill. Therefore, there is a potential mismatch for the purpose of impairment testing, which is avoided by IAS 36 requirements to gross up the goodwill included in the carry amount of the cash generating unit. However, when a parent initially purchases 100% of the subsidiary, the goodwill recognized in the consolidated financial statements represents 100% of the goodwill of the subsidiary. This remains the case after a disposal of a non-controlling interest in the subsidiary, even when components of non-controlling interest that are present ownership interest recognized subsequent to the acquisition are measured at the proportionate share of the net assets. Therefore, grossing up goodwill for the purpose of impairment testing will not be appropriate. For example, on 1st January 2023, parent P acquires 100% of subsidiary S for 1,900 CU. At that day, the fair value of subsidiary S's net identifiable assets is 1,500 CU. Parent P recognizes goodwill of 400 CU in its consolidated financial statement as a result of the business combination. On 1st July 2023, Parent P disposes of 20% of its interest in subsidiary S for 380 CU. For simplicity, it is assumed that the fair value of subsidiary S's net identifiable assets on that date is still 1,500 CU. Parent P recognizes non-controlling interest of 300 CU, that is 20% multiplied by 1,500 CU. And the difference of 80 CU between these amounts and the proceeds received is recognized in equity. Because control is retained, there is no adjustment to the carrying amount of goodwill, that is, goodwill remains at 400 CU. At the end of 20X5, parent P determines that the recoverable amount of subsidiary S is 1,000 CU. The carrying amount of the net assets of subsidiary S, excluding goodwill, is 1,350 CU. Because all of the goodwill attributable to subsidiary S is included in the recoverable amount of subsidiary S and is also recognized in parent P's consolidated financial statements, no adjustment is required to gross up goodwill for the purpose of impairment testing. In the circumstances described, an impairment loss of 750 CU should be recognized, calculated as follows. So, as at the end of 20X5, the carrying amounts of goodwill of subsidiary S is 400 CU, while the net identifiable assets is 1,350 CU. So we have a total carrying amount of 1,750 CU. We have the recoverable amount that is 1,000 CU. So by the time we look for the difference, we have 750 CU. In accordance with IAS 36, paragraph 104, the impairment loss of 750 CU is allocated to the assets in subsidiary S by first reducing the carrying amount of goodwill. Therefore, 400 CU of the 750 CU impairment loss is allocated to the goodwill, and remaining impairment loss of 350 CU is recognized by reducing the carrying amount of subsidiary S's identifiable assets. If a subsidiary or part of a subsidiary with a non-controlling interest is itself a CGU, cash generating unit, the impairment loss is allocated between the parent and the non-controlling interest on the same basis as that on which profit or loss is allocated. When non-controlling interests are measured at fair value, paragraph B45 of IFRS 3 indicates that the fair value of the parent interest in an entity and the NCI on a per share basis may differ. That is due to the inclusion of a control premium in fair value of the parent interest, or conversely, the inclusion of a discount to reflect its lack of control in the fair value of the NCI. In such circumstances, the goodwill attributable to the parent's interest is not necessarily proportional to the goodwill attributable to the NCI. Despite this fact, in line with the explicit requirements in IAS 36, any impairment loss arising on the goodwill should be allocated to the parent and to the NCI on the same basis as that on which profit or loss is allocated. That is in proportion to their respective present ownership interest. Impairment loss attributable to non-controlling interest relates to goodwill not recognized in the consolidated financial statement. Example, Entity A has an existing wholly owned subsidiary, Entity B. Subsequently, Entity A acquires 80% of Entity C in its business combination. Synergies arising from that business combination are expected to benefit Entity B. Accordingly, under IAS 36, some of the goodwill acquired in the business combination is allocated to CGUs within Entity B. Following the allocation of goodwill, Entity A compares the adjusted carrying amounts of the CGUs with its recoverable amounts. Entity A has chosen to measure the components of non-controlling interests that are present ownership interest at their proportionate interest in the net identifiable assets of Entity C at the acquisition date. Therefore, in accordance with IAS 36, the carrying amount of goodwill allocated in Entity C is grossed up to include the goodwill attributable to the non-controlling interest. On the basis of this comparison, Entity C is determined to be impaired. So we have Entity C with a carrying amount of 29,500 and a recoverable amount of 25,000. Hence, there will be an impairment of 4,500. Also, in a situation whereby we have Entity B having a carrying amount of 32,500 and a recoverable amount of 4,000, in this situation, there will be no impairment recognized. The impairment of 45,000 CU for Entity C relates to goodwill and is allocated between the parent and the non-controlling interest on the same basis as that on which profit or loss is allocated. That is 8% to the parent, which is 3,600 CU, and 20% to the non-controlling interest, which is 900 CU. But because impairment loss attributable to the non-controlling interest relates to goodwill that is not recognized in the parent's consolidated financial statements, the impairment is not recognized as a goodwill impairment loss. Accordingly, 3,600 CU is recognized as a goodwill impairment loss in the consolidated financial statements, being the impairment loss relating to the goodwill that is allocated to the parent, that is Entity A. You're muted, sir.
I said we'll look at other examples. Okay, can you look at these further examples?
Okay, other examples. Allocation of goodwill impairment loss. Oh, I can't see the heading properly.
No, just look at the heading buttons for allocation of impairment loss to goodwill that is measured as a result of value non-controlling interest at fair value.
Okay, Entity A acquires 80% of Entity B for 1,250 CU. Entity B has identifiable net assets with a fair value of 1,000 CU, and the fair value of the non-controlling interest is determined to be 250 CU. So we have the parent interest to be 80%. The share of identifiable net assets of parent is 800 CU, and the fair value is 1,250 CU. Hence, we have a goodwill of 450 CU, and the goodwill percentage is 90%. So we have NCI with 20% ownership, 200 share identifiable, 200 share of identifiable net assets. The fair value of the NCI is 250 CU. The goodwill allocation is 50, and that is based on 10%. If an impairment loss of 100 CU subsequently arises on Entity B's goodwill, it is allocated 80% to Entity A, that is 80 CU, and 20% to the NCI, which is 20 CU. Equally, if the impairment loss arising on entity B's goodwill is 300 CU, 60 CU, that is 20%, is allocated to the NCI, and 240 CU, that is 80%, is allocated to entity A. This is so even though in this example, the goodwill impairment allocated to the NCI exceeds the goodwill originally included in the NCI. If a subsidiary or part of a subsidiary with a non-controlling interest is part of a larger CGU, goodwill impairment losses are allocated to the parts of the CGU that has a non-controlling interest, and the parts that do not. The impairment losses should be allocated to the parts of the CGU on the basis of IAS 36, paragraph 7. You're muted, sir.
When we have unallocated goodwill, what should we do? Remember, we have discussed that before. And with respect to business combination, what should we do? Can you read that?
Okay. In any portion, if any portion of the goodwill acquired in a business combination during the period has not been allocated to a CGU, group of CGUs, or group of CGUs at the end of the reporting period, the amount of the unallocated goodwill should be disclosed, together with the reason why the amount remains unallocated.
Remember, I told you that you might not be able to allocate goodwill to all cash generating units.
Yes.
Again, disclosures will be required as necessary. Probably when we get disclosure, we'll look at some other ones. Now, let's now look at reversal of an impairment loss.
Okay. So if I may just quickly ask a question, I remember you said an unallocated portion should be recognized as liability, or am I making
We are saying unallocated impairment loss, not goodwill.
Okay.
Separate things. You know, we said goodwill should be allocated to at least one cash generating unit or more. And once you allocate it, you might allocate 80% of the goodwill to 3 cash generating units, and it's unpracticable to allocate the balance. Why can't you do that? Disclose that to us. Does that make sense?
Yes, sir.
Now, impairment loss in general can be reversed. But the condition is this: what brings about reversal of an impairment loss? It means what brought initially about the impairment loss, that condition that was negative has now turned positive. And if it has turned positive, it means there has been improvement in our cash flow such that the recoverable amount has gone higher than the carrying amount. In such a situation, we say that could bring about reversal of an impairment loss. But that doesn't mean there will be reversal, but that could bring about reversal of an impairment loss. Which means there are subsequent conditions we need to understand. One, the nature of some assets will not permit reversal of an impairment loss. Example, impairment loss on goodwill will never be reversed. We'll come to the reason. Impairment loss on equity, because primarily you shouldn't have recognized impairment on equity because equity should primarily be measured at fair value.
Yes.
But because you are unable to measure it at fair value and you were constrained to default to the cost by issue of policy adoption, which is IAS 27, where you are allowed to carry at cost in the separate financial statement of an investor, or by the principle under IFRS 9, where you have no reliable basis to measure the equity investment at fair value due to one reason or the other. And at that point in time, from inception, you have deemed it to be carried at cost. And compulsively, you have to subject it to impairment. But IAS 36 recognizes that you can't recognize impairment loss on equity except if you have considered it to be of a permanent nature, or because subsequent improvement in the equity position can never result in a reversal of such an impairment. which is second, equity investment that suffer impairment loss and of which it has been recognized previously can never be reversed. These are practical examples of impairment losses that can never reverse itself. Likewise, some others. Now, the question then is, except for this and other conditions alike, other assets to which they've suffered impairment loss, such impairment loss can be reversed. But again, reversal of an impairment loss will be treated as an impairment gain. Reversal of an impairment loss will be treated as an impairment gain. Therefore, what is an impairment gain? An impairment gain is the amount of reversal of an impairment loss that can be recognized in the financial statements. Why? Not necessarily all amounts of impairment loss that due to have reversed will be recognized as an impairment gain, or because there are certain restrictions or limitations in recognition. And we're going to look at that. Now, let me break it down further. Imagine an asset of 10 million. Carrying amount of 10 million last year was impaired by 1 million. The carrying amount now, as revised, is 9 million. Let's assume that that asset is not an asset that is subjected to depreciation like land. Let's pick land as an example. That 9 million, you brought it back to, is not the carrying amount even this year because it's not subjected to depreciation. This year, there have been improvements and development because government has started to put some infrastructure in place, like road, lighting, and other things, that has improved condition of that locality. And in that case, the value of the land has increased. And the value of the land has increased to 11.2 million. The question then is, it means that from 9 to 11.2 million, there's presumably 2.2 million increase in value that will have been recognized as a reversal of an impairment loss. But the answer is this truly that 2.2 million is a reversal of an impairment loss? The answer is no. Why? Because a reversal of impairment loss is subject to what was initially recognized as a loss over the life of that asset. The entire loss you have recognized over the life of that asset is 1 million. Therefore, how come 2.2 million is a reversal of 1 million? It's not done. Which means you can reverse more than that 1 million that will have resuscitated that asset back to its initial kind amount as if there were no impairment in the first case. Which then means that your impairment gain, which is a reversal, will be subject to the initial impairment loss or cumulative impairment losses on that asset, which is 1 million naira. And any other aspect will not be recognized, except if that asset is an asset that is carried at a revalued what amount, would not trigger that there is a revaluation in line with the requirement of IAS 16. If such an asset is carried at a revalued what amount. Does that make sense?
Yes.
And that is the position. Now, let me now further more that why is goodwill, impairment on goodwill, not reversed? Or why can impairment loss on goodwill, reversal of impairment loss on goodwill cannot be recognized? The first thing is for us to understand the requirement of IAS 38, intangible assets. Goodwill is closer to be recognized as an intangible asset. And by nature, the only goodwill permitted under IAS 38 to be recognized is the purchase goodwill that arose from a business combination. Now, if that is the case, any reversal of an impairment loss on goodwill will be tantamount to recognizing an internally generated goodwill, because it is the operation internal to the business that has brought about such a recovery, which will be synonymous to any other business having to put internal resources in place to generate value, of which the goodwill that are internally built are not recognized. because they are only inherent. Why? Because validating such might be difficult. Reliably measuring such might be impracticable, and that's why it's not recognized. And therefore, by conclusion, it is deemed to be an internally generated goodwill. That is why IAS statistics forbid the recognition of the reversal of an impairment loss on a goodwill. And that is that. Now let's look at some summaries from the position of the standard. I want somebody to read this out for us.
Okay, reversal of an impairment loss. The annual assessment to determine whether there may have been some impairment should be applied to all assets, including assets that have already been impaired in the past. In some cases, the recoverable amount of an asset that has previously been impaired might turn out to be higher than the asset's current carrying amount. In other words, there might have been a reversal of some of the previous impairment loss, in which case the carrying amount of the asset should be increased to its new recoverable amount. And A, if the asset is carried at revalued amount, for example, under IAS 16, the reversal of the impairment loss should be accounted for as revaluation increase. So applying IAS 16, recognized in other comprehensive income and accumulated as a revaluation surplus in equity. B, if the asset is not carried at revalued amount, the reversal of the impairment loss should be recognized immediately as income to profit or loss. The asset cannot be revalued to a carrying amount that is higher than its value would have been if the asset had not been impaired originally. That is, its depreciated carrying amount had the impairment not taking place. Depreciation of the asset should now be based on its new revalued amount, its estimated residual value, if any, and its estimated remaining useful life. An exception to this rule is for goodwill. An impairment loss for goodwill should not be reversed in a subsequent period. IAS 36, paragraph 124.
Thank you very much. That summarizes it all. Now let's look at this practice question, and I want you guys to provide me guidance. Can someone